bullishness in the top of the market is starting to filter down.
You're seeing stocks and bonds are trading uncorrelated, more like the pre-COVID period.
Investors are probably going to take another bite at the apple here.
The health of the stock market's going to depend on earnings.
I think the market can continue to broaden.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. Let's get your trading day started. Your equity market on the S&P 500, positive by 1/3%, coming off the back of the biggest one-day drop on the S&P 500 in around about a month. Equity futures look a little something like this. We're up on the Nasdaq by 0.4%. The Russell, totally unchanged. Two things to watch in the last 24 hours. One in the bond market, another in the commodity market. We look a little something like this right now. After breaching 4% and $80 a barrel on Brent crude for the first time since August, we pulled back on Brent. We're down about 2 full percentage points. The 10-year yield, that four handle, Danny, it sticks.
The two are certainly connected. The fact that you had oil going above $80 a barrel and a 4% yield on your 10-year. There was no clear catalyst beyond that. You had Fed speak that basically argued for gradual cuts, which gradually cutting into economic strength you'd have to imagine as bullishness. So it's the old habits die hard of equity markets yet again being frightened by higher yields.
As for crude, 5 days of gains in the oil market coming into today. We're talking about gains of more than 12%. Gains we haven't seen going all the way back to the time since Russia invaded Ukraine back in 2022.
This is all about the geopolitical risk, the idea that potentially you are going to get a wider regional conflict in the Middle East. You had Director of the CIA, Bill Burns, yesterday talking about you could see this potential for inadvertent collisions, misunderstandings, and actions that take on their own life. What analysts keep talking about, you have to not just think of what Israel could do in terms of Iran, but what Iran does back. Does that mean potentially hitting other Gulf supplies or cutting off the Strait of Hormuz?
There's a China effect in this commodity market this morning. You'll notice that across the board. You see it in base metals as well. Check out the Chinese equity market. Chinese stocks meeting gravity in a big way. We're talking about catch up here on the CSI 300 from a one-week holiday. The cleaner read on things. The Hang Seng. The Hang Seng in Hong Kong, big run over the last week, getting absolutely hammered this morning.
It's a mismatch of expectations that the NDCR would come out today with some sort of big added stimulus. They're not a government body that tends to do that, yet it's an equity market that ran up 33% in the last month, 25% for the Hang Seng. It's an equity market that expected some sort of bazooka. It doesn't negate what they already released, but it's a market almost trading it as if it does.
But the agency's talking about there's full confidence that they can get to the growth prospects, 5%. But then you see the World Bank coming out today and actually cutting how China is going to grow into next year. I love this quote from the chief Asia-Pacific economist at Natixis to the Financial Times. This is what happens when you feed the monster. Every day you need to increase the amount of food or it turns against you. The idea that until they change the fundamentals, which is consumer spending, which is the property market, this is all just a sugar high.
The Hang Seng getting hammered. Copper getting hammered. We're down about 2 percentage points on copper in London. Brent crude, WTI pulling back as well. That's a snapshot of the price action in the markets this morning. Coming up this hour, we'll catch up with Jeff Caffrey of JP Morgan Asset Management. Looking ahead to earnings, Leland Miller of China Beige Book as China's stock rally meets gravity, and Bloomberg Saleha Moshid as Florida braces for Hurricane Milton. We begin this hour with stocks recovering from the biggest one-day loss in about a month. Jack Caffrey of JP Morgan Asset Management is still bullish, writing over the next 12 months, I would expect the large-cap US equity market to deliver a return that is positive and most likely in the high single-digit range. Future gains are most likely to be supported by further earnings upside rather than additional valuation expansion. Jack is with us for more. Jack, good morning to you.
Good morning.
Where does the earnings optimism come from that underpins that call?
Well, I do think we have an economy which a month ago we were fearful we'd have a hard landing. Then it became perhaps a softer landing. And now, looking at the employment report and some of the revisions to the income accounts, it might not be landing at all and actually seeing the plane turning back up. I think underpinning that, companies continue to do a good job managing their costs. And I think that ultimately winds up turning, mid-single-digit nominal GDP growth into potentially high single-digit earnings growth on a going-forward basis. So,
are those companies concentrated in a particular sector?
I think actually you're seeing a broadening out from what's been a very tech-dominated market to more of a capital spending story broadly. You can actually see some consumer names actually continuing to do fairly well. And I think that sets up some interesting disconnects between what people might have worried about a month or so ago with a hard landing fear to maybe we not only muddle through, but actually pull back up a little bit.
Jack, if we can get more into the consumer names, PepsiCo, for example, just reporting a little bit stronger than what was expected. The fear last quarter had been unevenness among the consumer, meant that there were going to be clear losers. Are you saying that's less of a concern this quarter?
Well, I think with a lot of the consumer stocks, we were looking at companies that pressed really hard on the pricing lever and that they were willing to trade, I'm going to move on price and give up a little bit of volume. So I think without having seen the Pepsi numbers, I'd rather understand how much that trade-off is playing through. But to the extent you're seeing investors last week leaning aggressively into casinos, leaning into cruise lines, these are relatively big ticket purchases, not a house, not a car, but they're leaning into things where consumers are even borrowing a little bit of money to some extent in order to not miss out on an experience. And I think when you actually potentially are borrowing money at rates that could be 20%, when you look at where credit card interest rates are, in order to enjoy life, I think that speaks to a degree of confidence that your job is stable and maybe you're going to get a raise.
So just to kind of lay out where the bar is for this earnings season, just under 5% year-over-year growth is what's expected for earnings. Is that a bar that we're going to easily clear?
I think, given that we've pulled back over the last several days, it becomes much easier for companies to beat that. To the extent that many companies went through the conference season coming back from Labor Day, like, well, maybe things aren't so fantastic. I think companies they've been well trained over, call it 25 years now, to underpromise and ultimately overdeliver. So I wouldn't be shocked. And the VIX, I think, the VIX going from 12 to 20 suggests that there's a little bit of underpinning fear under that good enough might just be good enough.
You think picks, power shovels, more interesting right now than chips. Do you view utilities as defensive or growth?
It kind of depends on the day, whether investors are looking to utilities as traditional yield plays and taking advantage of the fact that they are paying you and that they have historically been a reasonable inflation hedge, being able to pass on their higher costs into the form of higher dividends. But now that we're talking about utilities potentially having to go on a really aggressive capital spending cycle based on the idea that AI power will consume all power effectively, you wind up seeing growth investors getting interested in utilities for the first time in, I guess, my many decades of life.
Do you think that at some point that ends? Like, how much could this be in terms of growth?
I mean, ultimately, it will come down to, can we start coming up with a story how AI actually starts translating into profitability for AI consumers rather than the AI investment angle today? Because right now, the story remains very much the enthusiasm in order to acquire chips or build the servers that make use of those chips. That's the somewhat trickier point, even with the enthusiasm around some recent fundraising rounds for a number of the AI providers, the model providers. If we go back, I like analogies. 25 years ago, we sat there and looked through multiple search engines before we eventually sort of settled on a dominant search engine. Why will that not be a reasonable proxy for what winds up being the experience looking at large language models, where we're going to experiment, we're going to try, and ultimately wind up with one? That might mean we wind up needing less power ultimately. And since power is tricky, you need to get permits at the state level, at the federal level. I would anticipate whatever you pencil in will take longer and cost more, ultimately.
This is something to think about over decades. Let's think about something for the next several days. We've got bank earnings on Friday. In conference season, we had a couple of warnings. One bank was talking about interest rates weighing on profitability. Another bank was talking about credit risk, or Ally Financial, in the auto loan book. What do you think is going to be the standout this earnings season from that sector?
I mean, ultimately, there's this balancing act. We've certainly seen credit measures getting a bit worse in parts of the ABS market, and in particular around auto delinquencies. And that's sort of interesting because in the GFC, auto credit did great when housing credit was relatively weak. So I think people are looking at auto as sort of an odd canary. You need your car to go to work. So I think that'll be an interesting thing to ultimately start teasing apart. But at the same time, if the consumer is going on cruises and potentially doing a version of buy now, pay later to consider going on vacation, I think it speaks to consumer confidence remains there, even if they might be looking at a little bit of sticker shock. So right now, I'm happy to try to understand how stocks react rather than trying to manage, a consumer credit book right now, specifically within a bank.
How rate sensitive is that sector? What's the relationship between the bond market and those cohorts of stocks?
It winds up being kind of, I wish I could quote you a real correlation figure, but I'd be making it up, to be honest. And I try not to do that. Ultimately, these are rate-sensitive consumers. And, I think when you look through some of the weakness we've seen in the auto markets, it speaks to the fact that that was a consumer cohort that went from 2-3% auto financing to 8-9% for a new car and 12.5-13% for a used vehicle, and used vehicles to some extent being the only game in town if we think back to 20 and 21. So, unfortunately, we're also in hurricane season, which is probably going to result in a whole lot of losses when we think about where the direction of headlines and the direction of travel is going to be. And I think that winds up, supporting used car prices. That'll feed its way into the insurance market and have some interesting wrinkles probably for auto financing.
Jack, we are in a moment, just speaking of the hurricane and geopolitical events, where outcomes are binary. There's potential devastation here in the U.S., depending on the path of Milton. There's a concern about what retaliation looks like from Israel. How, as an equity investor, should you approach that? Again, risks that tend to be quite binary.
Well, the reality is we want to focus on the long term. The quote you took from my comments basically tried talking about what's going to happen over the next year, where I have greater confidence in what's going to happen at 9:35 this morning. But the reality is I have to survive to 10 o'clock this morning in order to try to get to the next year. And so from that, a week and a half ago, we were sitting there thinking oil prices were effectively going to become a tax cut to the consumer, and one that was showing up on a weekly basis. And yet now we're talking about oil up 12% because of a shift in how small groups of people in various countries have responded or not responded and think through their response. So that moves into a layer of analysis that I don't have the tools to try to handicap. What I would say is generally it's been better to be a buyer on weekdays. And so to the extent that we wind up getting some fear in the market over the next week or two, I'm probably more inclined to be adding risk than reducing it. The reality is you don't buy flood insurance when there's a storm forecast. You don't buy fire insurance when your house is on fire. And with the VIX having, again, spiked noticeably higher over the past week and a half, markets are a little bit more fearful at the margin. There is no corporate bid because we haven't gotten into earnings yet. So over, call it a 2-week period, could there be a more dramatic drawdown? I think that's certainly a higher probability event than on any given day in the market. But over, give me 18, 24 months, come back to earnings, and I think that we wind up in a better place, mid-high single digits, maybe low double digits, but after 30%, hard to bet on another, after 2 years of almost 30%, hard to bet on something aggressively in the double digits, absent a great starting point, which would be kind of painful on the day that happens. Let's
get back to earnings. Jack, it's good to see you. Jack Caffrey of JP Morgan Asset Management. Danny mentioned PepsiCo. Third quarter core EPS coming in at $2.31. The estimate $2.30. Listen to the outlook. Full year organic revenue up in the low single digits. They had seen previously revenue up by around about 4% for the full year. This is what they're leaning on. And this is what Jack alluded to. Strong cost controls, aiding our profitability. Danny, the focus on tightly managing costs.
That was my takeaway. The fact that they were able to beat had to do with cost cuts. It goes back to this fear we've had last earnings season, that not all these companies are treated equally by consumers, and brand names maybe can't command the same type of price because there are those price fatigues of consumers trading down. But again, the problem always tends to be is that it's so uneven. There are companies that are still doing okay and are still benefiting, but for every PepsiCo that reports earnings, maybe you get that fear creeping back in.
That stock at the pre-market's down about 1%. The broader market's still okay. Equity futures on the S&P 500 up by 0.4%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Hurricane Milton is barreling toward the Florida Peninsula with wind speeds up to 155 miles per hour. It's expected to make landfall tomorrow, bearing down on a region still struggling to recover from Hurricane Helene. It isn't clear exactly where in Florida Milton will make landfall. Various computer forecast models are at odds, and the National Hurricane Center says airs of as much as 100 miles are possible in the days before a storm comes ashore. Meanwhile, Israel's multi-front conflict with Iran-backed militias is now entering its second year. The country's defense minister will be in Washington tomorrow as the nation weighs its response to Iran's ballistic missile attack last week. President Joe Biden has urged Israel not to target Iran's nuclear or oil infrastructure out of concern it could spark a wider war and push up energy prices. And more on those PepsiCo earnings. PepsiCo shares are lower in the pre-market, more than 1%, after the food and beverage giant reported its third quarter earnings. The company trimmed its growth outlook for the year amid slipping volumes of soft drinks and snacks. The maker of Lay's chips and Lipton teas is struggling to manage the impacts of higher prices, causing consumers to rein in spending in favor of store-branded options. The Pepsi maker still expects earnings to grow by at least 8% this year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Chinese stocks meet gravity.
It's difficult to kind of understate the impact that China has on the rest of the world. The Chinese policymakers are very much willing to step up and deliver what's needed, but they will deliver it at a measured pace. It won't happen in one go.
Leland Miller of the China Beige Book up next on the program, live from New York City this morning. Good morning. Check out shares of Pepsi in the pre-market. The stock is lower by a little more than 1 full percentage point. The latest numbers this morning, core EPS for the third quarter, 231. The estimate, 230. The outlook for full-year organic revenue up in the low single digits. They had seen something around 4%. A lot of this is going to be on cost management in the quarters to come.
It's really what allowed them in this quarter to still beat on EPS. The company said that consumers are going to remain value conscious. John, it is just a little bit of a reminder after strong economic data of the past month that there's still consumers who are not willing to pay up for brand names.
Pepsi down by about 1%. The broader market still okay. Equity futures bouncing back by about 0.4% on the S&P 500. Under surveillance this morning, Chinese stocks meet gravity.
It's difficult to kind of understate the impact that China has on the rest of the world. They've learned a lot from the lessons in 2014, 2015. They don't want to see a repeat of that kind of blow up in the stock market. The Chinese policymakers are very much willing to step up and deliver what's needed, but they will deliver it at a measured pace. It won't happen in one go.
So here's the latest. China's stock euphoria cooling as onshore markets reopen following a week-long holiday with traders reassessing the nation's stimulus efforts. Leland Miller of the China Beige Book is skeptical, writing, Beijing's goal, the logic goes, could only be to do whatever it takes to undo the policy mistakes that have weakened the economy dating back to early COVID. It's a compelling narrative, but it's wrong. Leland joins us now for more. Leland, welcome back to the show, my friend. Tell us why you think that's the wrong take.
I think a lot of people looked at what was happening. They said, wow, this is a Draghi moment. This is a whatever it takes moment because the Chinese economy is collapsing and Xi Jinping is finally going to come to his senses, return the economy to higher levels of growth, provide more stimulus, respect investors more. None of this was ever going to happen. There was a problem. And the problem was that there was a doom loop in terms of confidence. Consumer sentiment's falling. Investor sentiments falling, household sentiments falling. Everybody was getting gloomy. So they wanted to step in with something that was a little bigger and louder than what they've been doing in previous months and previous years. So they did that. And there was a big reaction in the stock market. But the implications of these stimulus announcements, and again, most of them have not been put into effect. They've just been giving guidance on what may be coming. A lot of these are really big for stocks, at least in the short term, but they have very different implications for the macro economy. They're there to set a floor on growth. They're not to reach for a higher ceiling. So I think from the very beginning, investors have been way too giddy about this outside of short-term asset markets.
So how does the PBOC or how does Xi Jinping, the officials out of Beijing, basically get out of this doomed confidence loop that you think they're currently on?
Well, they may not be able to in a big way. What they've been doing, what they've been trying to do for years and will continue to do for years is deflate the property bubble because they see it as a vulnerability to the economy and thus a vulnerability to the party. But you can't take 25% of your economy and just gear it down to mid-single digits. You have to, sort of cull the herd, as we call it, take out the weak firms, step in to tighten credit, et cetera. But when you run into problems, then you have to ventilate. And the ventilation is easing. It's providing more broad access to firms so that cash flow doesn't freeze up and the strong firms don't go down. They've been doing this cycle for years now. The problem is that it stopped doing much. And so each time when they ventilate, they're going to have to do a little bit more to ensure to the markets that they're there, that there is policy support. But make no mistake, their goal is not to bounce things back up. It's to manage a long-term slowdown in property, a long-term slowdown of the economy, and to set a floor on where things are going so that Xi Jinping and the leadership can focus on national security priorities, which are really the tier one thoughts in their mind right now.
Well, when it comes to national security, how much do you think what China has done recently in terms of stimulus measures is to just get ahead of potentially more tariffs, more export controls when it comes to the next administration, whether it's Trump or Kamala Harris?
Yeah, I don't think it's about that. I think they stepped in because they saw what we did in our September data. So, the economy is not in cataclysmic shape, but it was a very weak economy, and September was particularly bad. If you look at September data, the credit data, we had the lowest interest rates. The rates had dropped the lowest rates we'd seen in almost 15 years. So the history of China Beige Book, and yet borrowing matched the lowest level we'd ever seen. Pent-up demand, the lowest level we've ever seen. Loan applications, lowest level we've ever seen. So things were really stopped up in the system, and I think they needed a bigger oomph. I don't think they're quite looking forward yet to who's the president of the United States, although there will be issues to contend with next year, depending on who it is.
Leland, you're describing a lot of smoke in the economy, but is there fire? Because often the deflationary spiral risk is stated as fact. Is it fact in China, and that you need something like a bazooka of policy assistance to stop it?
That's a great question. The economy is not in broad deflation right now. There's some elements of exporting deflation, and the risk in the future is deflation and exporting deflation. So that's definitely there. But I think the reason that so many people got this stimulus package wrong is that they thought the economy was in free fall in September. Like I said, there are plenty of things to be critical of. It was a weak economy. It was weaker than it was earlier in the year in across our data, but it was not collapsing. And so I think the people have to understand that as weak as China's economy is right now, it's not falling off a cliff. It's not terrible. They didn't have to step in and do whatever it takes in order to bail out the economy from some sort of collapse. They just wanted to step in to stabilize it because what they were doing before wasn't quite working very well.
It's often said that China wants to avoid some of the stimulative measures that you see in Europe or the U.S., things like direct stimulus to consumers. Leland, with that sort of attitude in mind, do you think something like a 33% rally over the past month for Chinese equities is something policymakers will want to avoid a repeat of?
Well, they seem to be doing it quite a lot, and then it loses steam, and then they're back in a pickle before not too long. It's very important for everyone to understand that there's a very big difference between the stock market and the real economy. If the government steps in and puts an implied put on short-term asset markets, you go into short-term asset markets. I mean, that's just being a smart trader. It's totally different from expecting big things in the Chinese economy. And if you look at what they promised on the consumption side and what they've delivered so far or announced formally so far, it's very little. They don't want to be doing as much as markets expect right now. So you have to make sure you have one eye towards the stock market. There's a dynamic going on there. You ride it until it's done if you play the stock market. But in terms of the macroeconomy, you have to understand that they're not trying to do bigger things. This is not some sort of grand structural pivot. It's not a whatever it takes moment. And so you have to have much more modest expectations of where things are going from here.
Leland, appreciate your insight. As always, valuable. Leland Miller there of the China Beige Book, very skeptical about the latest efforts coming out of China. We've had a lot of people come on this program and call it a trade and not an investment. You've heard that on repeat. The Hang Seng overnight getting absolutely hammered, down by 9%.
And just based on what Leland says, it's an expectation mismatch that so many people viewed China as an economic catastrophe waiting to happen and something that needed a huge amount of policy. China approaches this and says, we just want to get growth to 5%. We're just trying to put a floor under things and don't want a huge takeoff in GDP, don't want a huge takeoff in something that looks like the property bubble. So it's equity investors and policymakers just not aligned on the thinking.
Trying to close that gap overnight in the Hang Seng in a pretty vicious way. That's the latest out of China. The latest stateside. Equity futures up by 0.4% on the S&P 500. Up next on this program, we'll take you live to Tampa, Florida, where residents are preparing for Hurricane Milton. That conversation is just around the corner. Live from New York City this morning. Good morning. the 4-week rally hitting pause, starting the trading week on a little bit of a down note on the S&P 500, the biggest one-day loss in around about a month, going back to early September. Here's your bounce, up by 0.4% on S&P 500 futures. On the Nasdaq 100, up by about 0.5%. The utilities having a tough time yesterday as yields pushed higher, back at 4% across the curve. Check out the curve this morning: 2-year, 10-year, 30-year. The 10-year move sticks. Yield just about unchanged on a 10-year maturity, 4.02% on a 2-year, down 2 or 3 basis points to 3.96, call it 3.97. Plenty of speculation as to what the Federal Reserve will do November 7th. We need to get to the ECB first. The Bundesbank chief out this morning suggesting he is open to an interest rate cut. The euro still south of 110, 109.90 on euro dollar. Under surveillance this morning, China's stock rally losing steam after officials stopped short of unleashing more stimulus. The country saying it's confident in reaching its economic targets this year and promising to further support growth. Elsewhere, New York Fed President John Williams telling the Financial Times the central bank is well positioned to pull off a soft landing for the economy. Fed Governor Adriana Kugler saying the central bank should keep its focus on bringing inflation back to its 2% target with a, quote, balanced approach. And finally, Hurricane Milton barreling towards Florida as a catastrophic Category 4 storm with sustained winds of 155 miles per hour. The hurricane expected to make landfall sometime tomorrow. ABC's Rena Roy joins us now from Tampa. Rena, thank you very much for joining us at what is a difficult time for the people of Florida. Walk us through how unique this particular hurricane actually is.
Yeah, well, John, absolutely a difficult time, really just a 1-2 punch here in Florida. And let me tell you that officials are calling Milton the storm of the century, and they are urging people to take it seriously as it closes in. And it really does seem like a lot of people are taking it seriously. Traffic was backed up for miles as thousands evacuated the Tampa Bay area here. Right now, Milton is a Category 4 storm and expected to weaken into a Category 3 when it makes landfall here sometime Wednesday night or Thursday morning. But the impacts of this storm are expected to be devastating, especially here in the Tampa area. Less than 2 weeks ago, Tampa avoided a direct hit from Helene, but it is right in the path of Milton at this hour. Some areas could see up to 18 inches of rain. And storm surge could be anywhere from 10 to 15 feet, which is historic and life-threatening. We've seen people here sandbagging, boarding up, and stocking up on supplies to prepare for this. All of this as they still, of course, try to recover from Helene. And FEMA says it has 20 million meals and 40 million liters of water ready to be sent out. John.
Rena, I'm just going to pick up here. Governor Ron DeSantis yesterday talked about how this is going to be an emergency in 51 counties. What else are local officials telling these residents in these counties that are designated emergencies right now?
Yeah, well, they're really telling them that they need to get out if they are in the mandatory evacuation zones, and saying if they don't, that they cannot promise that first responders will be able to get to them because of just how life-threatening and how dangerous this storm surge is. Because Tampa Bay has never seen storm surge of this caliber. We are talking about 10 to 15 feet here. During Helene, we saw about 5 to 7 feet, and that itself was catastrophic. So you can only imagine how damaging this one will be.
Rena, appreciate your time this morning. Stay safe. Rena Roy there of ABC in Tampa on the latest as Hurricane Milton barrels towards the people of Florida. It's not a time where politics is top of mind, but we have to talk about the upcoming election. Anne-Marie, Henrietta Tracy is going to join us a little bit later on this morning. Some of the stats that she's sharing with us ahead of time: 17% of the critical battleground state of North Carolina is currently in a FEMA-designated disaster zone.
It's pretty incredible when you look at the counties that were hit the hardest by Helene and then also the counties that voted for the former President Donald Trump in 2020. These are Republican-led counties. She talks about how Republican voters outnumbered Democrats in the Helene aftermath 2-1, which is why you have a lot of concern, especially on the Republican side, about to make sure these people can go out and vote. How are you going to go out and vote when you don't have power, don't have access to clean water, barely can get your kids back to school? These are a lot of the questions ahead of November 5th.
Henrietta joining us in about 40 minutes' time. This is what she had to say. Entire zip codes across 3 states, Florida, Georgia and North Carolina, which will likely expand to include a big chunk of middle Florida by the end of this week, are entirely without access to mail. That means mail-in ballots getting to those homes, let alone returning fully filed out from those homes, just got dealt a massive blow. That's how difficult things are right now in this country. Bloomberg's Saleha Mohsin joins us now with a look at how the administration is preparing for the storm. Saleha, welcome to the programme. Walk us through what's being done and whether these states are getting everything they need from the federal government.
Well, there's a lot of confusion, actually, because the White House is rolling out some measures promising federal support to match state and local support. And then on top of that, have more cash and troops available to help in those situations, and encouraging people to evacuate with clear messages that if you don't evacuate, you will die. So that push, that urgency is really trying to get people out of their homes, even if it doesn't look dire in the moment. But at the same time, we have former President Donald Trump, who is telling people at rallies that there's a paycheck coming to you, and conflating a couple of different policies. So I think it's going to be a little bit difficult to get through some of the misinformation that is traveling around, even as these people are trying to figure out, like Anne Marie said, how to get their kids to school and how to take showers, voting and trying to figure out who's telling them the truth about what federal and state aid is available is not exactly top of mind.
Well, Saleha, looking at FEMA's daily briefing yesterday, they said just 9% of their personnel, which is just over 1,200 people, were available to respond to the remainder hurricane disasters on the horizon, a.k.a. what is about to happen with Milton. And then if you look at historically, this is much less, even from 2017 when FEMA was very stressed after Harvey, Irma, and Maria. What is FEMA doing in the fact that they have these stretched resources right now? What else can they do? Where can they go to rely on some new personnel to go help these individuals in Florida?
This is a stigma that's been plaguing U.S. resources since Hurricane Katrina brought a lot of this to light, 2 decades ago. Something that George W. Bush in his reelection bid had to really face up to some of those problems. FEMA is, yes, like you said, they're completely stretched. They have multiple crises coming from multiple different fronts. I don't think that they're prepared for these kinds of extreme weather events converging all at the same time, and all eyes are on them as people try to figure out what to do next.
Saleha, what seems to be the willingness of Congress to approve for more funds when you have Speaker Johnson saying he's not going to recall them back to Capitol Hill? Does there seem any willingness to extend those funds to FEMA to make sure they don't have a cash crunch at a time when they desperately don't want that?
Yeah, this is once again partisanship at its worst, right? So Republicans don't want to, the ideological sect or part of the Republican Party does not want to do anything that could possibly help Biden and then have a domino effect that would help Kamala Harris. And Biden is trying to get as much money across the border, lead some of the charge. Harris is also urging FEMA. We heard from Harris during her 60 Minutes interview last night, kind of confirm that Ron DeSantis is not taking her phone calls. Traditionally, this is a moment where we do see bipartisanship, where elected leaders, whether you're a governor or a mayor or a lawmaker or the president or vice president, the elected leaders ignore politics, rise above that, and take each other's phone calls because you need to be constructive. Now, we don't know what's going on between Biden and Ron DeSantis, but right now we're seeing that in Florida, this has come down to party lines.
Saleha, I've got to bring this up, and I'd love your thoughts on this. He's the governor of a state that's about to suffer an unprecedented 1-2 blow from hurricane after hurricane. Why would he take a call from the vice president, who quite clearly is also trying to play politics with the moment on the campaign trail? Why does he need to speak to the vice president?
That's an absolutely good point. And there is a poll that just came out fresh from the New York Times Siena. And that polling shows that Harris is a full 14 percentage points behind Donald Trump in Florida. So you're right. He should be taking calls from the president of the United States and key lawmakers. And maybe it's not, necessary for him to take calls from the vice president.
If I can just bring it around to the issue of voting, and obviously these places have more to worry about than voting. But in a state like North Carolina, Saleha, where already there's a culture of in-person voting, there are already strict rules when it comes to things like voter ID and time frames for which you can get your mail ballots back in. Is there a conversation at all about relaxing some of those measures?
I think it's too soon to say right now. Yes, a lot of the polling stations and precincts have seen a lot of physical damage. A lot of the COVID era, in 2022 or in 2020, when people were worried about getting to the polls, being exposed to the latest wave of the virus, a lot of voters, I think a quarter of the voters roughly, turned to mail-in ballots and early voting. We saw a lot more of that for Democrats. Twice as many Democrats did early voting and mail-in ballots than Republicans. And this year, we're seeing more Republicans spend, Republican, like the Democratic Party at the state level, spend a couple of $1 million trying to encourage their voters to take advantage of these. In the swing states like North Carolina and Georgia, this is going to be key. But like we've been talking about, it just depends. Even if those facilities are available and the logistics are made easy, are people motivated to put their lives and their livelihoods and their children on the back burner to fill out their ballots?
So, yeah, I also realize that in Florida, there's also a pretty contentious Senate race. Rick Scott trying to hold on to a Senate race. How potentially could this hurricane impact that down ballot key race?
I mean, the Senate is a close call. Just like everything with this race, Anne-Marie, the Senate is going to be a really close call. If you talk to investors and market strategists, they are constantly looking at the down ballot implications for policy. Taxes are not tax policy is not developed necessarily at the White House. All of this happens in Congress. So whether the Senate goes Republican or Democrat, and whether the House is able to flip or it is able to keep its current constellation of power, is going to have huge implications for future policy. And it's pretty interesting and kind of surprising that extreme weather events, even though there's been so much contention around the reason behind so many extreme weather events, is going to be something that is going to unravel the current state of the race.
Important moment for this country this morning and through the next 24 hours. Saleha, appreciate your time as always. Saleha Mohsin of Bloomberg down in Washington, D.C. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hekes. Hey, Yahira.
Hi, John. NVIDIA has partnered with Hon Hai, also known as Foxconn, to boost its server capacity as it sees, quote, crazy demand for its AI chips. The Taiwanese company is currently building the world's largest assembly plant in Mexico, which will be used for servers housing NVIDIA's most advanced Grace Blackwell chips. According to Hon Hai Chairman Young Liu, the facility will have a planned capacity of 20,000 servers in 2025. Meanwhile, China is weighing a series of tariff hikes on goods from Europe as tensions continue to escalate. The Ministry of Commerce said the tariffs could target gas-powered cars as well as European brandy, which would face a duty of nearly 40%. The comments come a week after EU officials began imposing tariffs on Chinese electric vehicles. Talks remain ongoing between the two sides, with some investors hopeful an alternative to the tariffs will be reached. And the end of the dock workers' strike has saved manufacturers from a port disruption surcharge. Maersk has announced it will drop a planned extra fee for handling goods at U.S. ports after dock workers and the container shipping industry group agreed on a tentative deal. The previous contract between the two groups has been extended through January 15th of next year, but the union and industry group will have to come to a long-term agreement before that date to avoid another strike. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, here come the upgrades.
Having stronger growth data is much more important than pricing out a couple cuts in our view. So, we would still be relatively positive on the outlook for equity markets here.
The latest from Goldman Sachs up next on the program, live from New York. You're watching Bloomberg TV. One stock with earnings this morning. Let's talk about Pepsi. PepsiCo in the pre-market is down a little more than 1 full percentage point. Out with earnings just a few moments ago. 231 against an estimate of 230. Danny and I were talking about this a little bit earlier. The CEO, Danny's strong cost controls aided our profitability. The outlook gets trimmed just a little bit into year end.
They're talking that consumers are still value conscious. Again, it's a reminder after strong economic data that there are still consumers who are strained. You can even see it in the credit card data released by the Fed. Credit borrowing is coming down because people are trying to pay off the debt that they already have. There are consumers who are still struggling to keep up with higher prices, despite, again, on a headline level, an economy that is strong.
That's the latest on PepsiCo. More earnings through the week. We'll hear from Delta. You'll get the banks on Friday, JP Morgan and Wells Fargo. Check out China. Just want to give you an update. If you are just joining us this morning, you might be interested in what happened overnight in Chinese markets as they reopen onshore for the first time in about a week following a week-long holiday. They were playing catch-up. CSI 300 closing higher by close to 6%. Cleaner read on this. The Hang Seng Danny getting absolutely hammered, down by almost 10% at the close.
I'm still really interested in this idea that it was just a mismatch between what the markets expected and what policymakers actually wanted to achieve. This idea that it is not an economic catastrophe waiting to happen. Instead, it's just trying to put a floor under growth, that it doesn't need a whatever it takes moment, so they're not getting a whatever it takes moment. The market, on the other hand, was expecting that, and hence you get that disappointment in equities this morning.
That's the latest out of China. Stateside equities firmer by a third of 1% on the S&P 500, and a 10-year yield that clings to 4%, 4.0256, following a blowout payrolls report on Friday. Under surveillance this morning, here come the upgrades.
Having stronger growth data is much more important than pricing out a couple cuts in our view. So, we would still be relatively positive on the outlook for equity markets here. I think you need a sort of inline inflation print on Wednesday, and then the start of earnings season. You just hope that looks a little bit cleaner than last earnings season. So this is a growth story. There's a growth market we're living in.
So here's the latest. Goldman Sachs upgrading the S&P 500 target, predicting the index will hit 6K by year end and 6,300 in 12 months' time. The team at Goldman writing, the primary driver of the upward revision to our 2025 EPS estimate is greater margin expansion. The macro backdrop remains conducive to modest margin expansion, with prices charged outpacing input cost growth. Ben Snyder at Goldman Sachs, responsible for some of these calls, joins us around the table. Ben, good to see you. Welcome to the programme.
Good to be here.
Let's get to the margin expansion, the pricing power. Where does that pricing power come from right now? Who's got it?
I heard you just mention it with this morning's results from Pepsi. And basically the way we think about margins is price inflation minus input cost inflation. And we've all been so focused on price inflation, and it has slowed. But input cost inflation has slowed even more. So, for example, if you look at unit labor cost growth in the U.S., which is wages adjusted for productivity, that grew at basically 0% last quarter.
Economists have been trying to figure out if layoffs come next as they start to protect margins just a little bit more. How do you think about that as an equity strategist? Are the layoffs coming?
It's great you raise it in the context, because I view profit margins as a really useful leading indicator for layoffs. And I think it's very intuitive. If you run a business and your margins are contracting, that would probably lead you to hire fewer employees or maybe even lay some off. But the good news is today margins are expanding. And I think that really confirms the strong labor market data we saw last week.
And you also write, though, by 2026, which, first of all, hats off for having any idea what 2026 looks like. But by that time, you start to have a limited ability to expand margins. What's happening to corporate America over the next few years where that can't continue?
Well, like everyone else, like the market, we're trying to be forward-looking. We could get surprised. But at the moment, our view is that growth by then will be close to trend, and the labor market will have tightened a little bit as opposed to the loosening we've seen over the last couple of years. In that kind of environment, growth can still be very solid, but typically it's harder for companies to really expand margins.
So how uneven is that going to be? Because I know you're talking about it on a headline level, but again, John and I were just talking about Pepsi needing to cut costs, feeling some volume difficulty. How even will the ability to expand margins next year be?
It actually looks to us like the ability of companies to expand margins is improving, not getting more narrow. One of the characteristics of the market over the last couple of years, as I'm sure most of our viewers know, is that it's been a pretty narrow breadth market. Technology stocks have been able to grow margins. Everyone else has kind of struggled. But now, with the economy in such good shape, it really looks like more and more parts of the equity market are able to raise profits as well.
Ben, let's talk about the corporate tax rate for next year. We can have 28% or 15%. The Democrats took your recent note by you and the team and really ran away with it because what it would mean for growth, but ignored what it actually mean for corporations' bottom line. What could we see with a 28% corporate tax rate?
We've put those proposals through our models, and we estimate that those could have, of course, a substantial impact on earnings, just as we saw in 2017 and 18 under the TCJA tax cuts. But I think it's important to note, you mentioned 15% and 28%. Those aren't the only options. It's always possible that tax policy falls somewhere in the middle or just remains where it is with a federal rate of 21%. And then, of course, there are a whole number of other factors to think about as well. There's fiscal expansion, there's tariff policy, and then, of course, there's the primary driver of earnings, which is GDP growth. And so ultimately, there could be a change to the earnings outlook post-election, but from our perspective, the much more important driver is the strength of the economy, the margin story we were talking about earlier. And so net-net, we feel very comfortable about the path going forward.
If there is a 28%, though, corporate tax plan for the policy, you say that can cut S&P 500 earnings by 5%. What would that do to your 2025, or to Danny's point, if you can look into the future, 2026 price targets?
Yeah, so keep in mind, it's a one-time shift to earnings. And right now, we're forecasting 11% earnings growth next year. So If we were to subtract 5% from that, we'd get about 6% earnings growth, which coincidentally is where our forecast was last week before we raised our estimates.
Harris's proposal is clean, at least compared to Trump's proposal. Can we talk about that? 15% with a condition, a manufacturing condition here in the United States. How are you and the team considering that? How do you put that through any kind of model?
It's difficult to do. 15% is relatively straightforward, and we've run those numbers. And then I think the question is uncertainty. And actually, that is the key dynamic that we've seen historically around elections. You know, there's been a lot of discussion about tariffs and tax. But ultimately, if you look at every single presidential election year, uncertainty is really the most important thing for stocks. And it's this period, the weeks before the election, when uncertainty tends to be highest. That leads to higher implied volatility, a little bit of market weakness. But of course, the flip side of that is after the election, that uncertainty moves lower and stocks usually rise higher. And as you mentioned earlier, we expect the S&P to repeat that pattern this year.
What do you make also on impact, say, to a company like Deere? The former president is talking about tariffs on Deere if they move some labor and production to, say, Mexico. How do you envision all of this coming into play in 2025 if the former president is in the White House?
Yeah, I think basically my read from all of this policy discussion is that it's much more going to be a story of rotation within the equity market than a dynamic that affects the level of the S&P in aggregate. And you can see this if you look at correlations with prediction markets over the last few months. For example, small caps tend to have performed better as you've seen Republican odds rise in prediction markets. And so ultimately, depending on the policies that are actually laid out by whoever the next administration is, I think that will change where we think within the market investors should invest. But in aggregate, I don't think it's really going to change our view very much.
Let's get the sector call then. Favorite place to be within the equity market at the moment. Where is it?
I think the key change that is happening right now, no surprise, is the actual Fed cuts. And the market is forward-looking. We've seen the long end of the yield curve decline well in advance of those cuts. But the actual cuts themselves do seem to be having some impact on economic activity. So, for example, mortgage applications have risen in the last couple of weeks. We've seen very, very little housing turnover over the last couple of years. I think you can imagine that as the Fed cuts, we'll see more housing turnover. And that means if you're a broker, if you sell furniture, there's a lot of potential earnings upside ahead.
Ben, appreciate it. It's good to see you. We'll do it again soon. Ben Snyder there at Goldman Sachs on what the election means for your equity market. And a big call on the S&P 500. An upgrade at least. 6,000 year end. Not too far away from that. 6,300. Danny, in the next 12 months.
It's, again, this idea of get back to basics. Focus on earnings. Focus on expanding margins. But again, it's this feeling that in the meantime, it's of the uncertainty that Ben was talking about. And at an election, how much runway does an equity market really have when you have two different outcomes, some which are more understood than others?
And TCJA, the corporate tax rates, all of these provisions potentially, they're going to be renegotiated in Congress. And right now, Kamala Harris is running on a 28% corporate tax rate, and the former president is running on a 15% corporate tax rate with conditions, as you mentioned, Jonathan, which we really don't understand, about being made in America. But you have a great point when Ben talks about the fact that this is a huge spread and potentially we end up with something in between.
Some good news in this conversation. Corporations in America able to expand margins. What they're not doing, laying people off. And we didn't see much of that in the payrolls report on Friday either. Up next on the programme, in the second hour of Bloomberg Surveillance, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge. We'll speak to Henrietta Trays of Vader Partners on what the hurricane in Florida could mean for the upcoming election. Cleet Williams of Aiken and Christina Campmany of Invesco on the other side. The second hour of Bloomberg Surveillance up next. Equity futures on the S&P positive by 0.4%.
We're thinking that the economy is going to continue to perform quite well.
Almost 50 basis points of cuts have been taken off the table.
Some people call it a bumpy landing. I think that's what we're in for.
It really is Goldilocks with inflation back close to 2% and the economic data just continues to power along.
I honestly think this economy's landed months ago, and it's time for someone to call it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Programming alert, 9:30 Eastern Time, Bloomberg TV and Bloomberg Radio exclusive conversation. Jamie Dimon, the CEO and chairman of JP Morgan, sitting down with Bloomberg's Lisa Abramowitz. Do not miss that conversation later on this morning. Here in New York City, good morning, good morning. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 firmer by 0.4%, bouncing back Across the board on the Nasdaq, we're up by 0.4%, a bit of a headwind building in the bond market. Yields back at 4% across the curve. That move sticks, Danny, on a 10-year.
I do think it is notable that equities had their biggest day of selling in 1 month with higher yields. It's this idea that the bond market had to recalibrate, that the fundamentals of this economy were stronger, but maybe the equity market was already pricing that in. And instead, it needs to worry about the old hat of inflation. What does that mean for Thursday's CPI report? Are we going to have to worry yet again that this is something that can upset risk assets? It's kind of a familiar and uncomfortable position to be back in.
And what to do with the energy piece of the puzzle as well. Brent crude briefly breaching $80 a barrel, back down to about 79.46. Quite a 5-day run, the biggest 5-day run. 5-day rally on Brent crude going back to spring of 2022.
And the only reason why you see a bit of red right there is because people were expecting this Draghi-like moment, as Leland Miller put it, of China Beige Book when it comes to China. So potentially this morning they're waking up to the demand that maybe is not coming back fully in China. But really the story is a geopolitical one. And this week we're going to see the Israeli defense minister come to the United States as we await their potential retaliation. And then what everyone is looking at is, then what does Tehran do in terms of that retaliation? And does that actually impact the supply in the Middle East?
You mentioned China, the Chinese story getting sold pretty hard on the Hang Seng. The Hang Seng down by more than 9% at the close over in Hong Kong. Playing catch up over the mainland in China, the CSI 300 positive by about 6%. Coming up this hour, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge on why the economy keeps surprising markets. We'll speak to Henrietta Trays of Vader Partners as Florida braces for Hurricane Milton, and Cleet Willems of Aiken on why you should take campaign promises with a grain of salt. We begin this hour with stocks little change following the biggest one-day drop in about a month ahead of inflation data later on this week. Mohammed Al-Erin of Queen's College, Cambridge, expecting more data surprises, saying, quote, last Friday's data surprise relative to consensus expectations will not be the last one unless economists resist the temptation to look through the shock. What is needed in today's economy is to be more open-minded about why such surprises keep occurring and how best to frame the accompanying policy regimes. Mohammed, I'm pleased to say, joins us again. Mohammed, welcome back to the programme, sir. Let's get into that. Why was it the volatility between reports that stood out for you and not just the strength in isolation?
Thanks for having me, John. Look, this volatility, or what you've called ping pong narrative, has been with us for a while. And there's a clash. There's a clash between the mindset of most analysts that tend to think that the economy is in a structural equilibrium and the reality that we are going through major transition, both economic and policy-wise. So if you're thinking one way about the economy, but it's operating in another paradigm, you will get these surprises.
So the obvious question would be, Mohammed, when you write things like how best to frame the accompanying policy regimes, what the Federal Reserve should be doing with this incoming information?
So first of all, understand that we're going through structural changes. Luckily for us, these changes are favorable, unlike what you're seeing in Europe, unlike what you're seeing in China. That's the first thing. The second, it's not just about monetary policy. Yes, the Fed was the only game in town, but that's no longer the case. Fiscal policy is having an impact. Structural reforms are having an impact. So think beyond the Fed. So what does it mean for the Fed? Continue in what I sense, and I hope I'm right, I sense is to evolution in how they are approaching policy. And you see this a little bit in John Williams' interview in the Financial Times. The first one is to be less excessively data dependent and have a more balanced, backward-looking, forward-looking approach. And the second one is to get away from this notion that you can target a specific outcome and have much more of an insurance mindset. And I think that if these two evolutions are correct and continue, it's good for the Fed and would be good for the economy.
Mohammed, just to that point, Adriana Kugler spoke yesterday, too, and said that she's monitoring both Hurricane Helene and geopolitical events, but then goes on to say that the fear is that they could have an impact on American employment, that risks escalate, uncertainty escalates, and that means that the Fed might have to move more towards neutral more quickly. When you look at these exogenous shocks, is it still a Fed put? Is it a Fed that's going to come in and not cut and maybe isn't as concerned about the inflationary risks of, for example, targeting oil capabilities by Iran?
Danny, the hardest thing is when the external shock, whether it's coming from oil prices, whether it's coming from a supply disruption in the port, or whether it's coming from this awful hurricane down south, The hard thing is when it's stagflationary, when it lowers growth and increases price pressure. That is when the Fed gets into a really difficult situation. Let's hope that none of these potential external shocks, one of them is resolved, but the other two are not. Let's hope that they don't, because it will make it very hard for the Fed to decide what to do. I think, and I've believed for a long time, that the economy is fundamentally sound, so it can absorb shocks. What it cannot absorb is a policy mistake.
Mohammed, when it comes to these potential policies and these exogenous shocks that Danny is talking about, the big unknown is obviously the composition of Washington next year. How should the Fed be thinking about 2025 when we might have very different policies coming out of the White House and Congress?
I think they have no choice but to do what they said they do, which is we will wait. We will see what happens in the presidential election. We will see what happens to Congress. We will see to what happens to actual, as opposed to stated, policy approaches. And then we will include this in our assessment. Anne-Marie, it's very difficult to move earlier. If you were forced to move, you'd be more cautious on the inflation side for both candidates.
Is that why potentially we got this clear guidance today from President Williams in the Financial Times, basically saying follow the dot plots, don't read into the 50 basis point cut that was the exception, not the rule? Because on November 7th, they may be meeting without knowing the results of the election.
Yeah, I think they want to pivot away from the 50, because I think that if they knew then what they know now, they wouldn't have done 50. They would have done 25, as many people proposed. So they're trying to pivot away from the 50 and get the conversation forward-looking. And I think you see that in commentary over and over again coming out of the Fed.
Mohammed, still every Fed speaker that talked yesterday backed 50. No one tried to walk away from it. I mean, of course, they probably wouldn't make a mistake. But what does that tell you about Chair Powell's still hold on this committee and to direct monetary policy?
Danny, look, they have no choice but to defend the 50. Because there was only one dissenting vote. So, of course, they have to defend the 50, saying what we knew then, okay, led us to 50. I think it's John who called it a Draghi moment, the first time we've really had a Draghi moment by Chair Powell. It was an important moment that he got done, and he was willing to tolerate one important dissent. I don't think he's going to play that card over and over again.
Mohammed, I'd love your thoughts a little bit deeper on what we saw from Colby Smith and John Williams in the Financial Times. I'll share the quote with you, the direct quote. If inflation falls even faster than expected, that would, quote, call for policy to normalise a little bit more quickly. If inflation stalled, that would call for interest rates to come down more slowly. There's a bias there, Mohammed. It's to reduce interest rates. And it's a bias to reduce interest rates based on what happens with inflation, not what happens with payrolls. And I'd love your thoughts on that, because last week, before we spoke to you, before we had that data, we had some guests point out that maybe the inflation data didn't matter anymore. Do you think it's the inflation data will set the tone for the pace of interest rate reductions over the next few quarters, and maybe not so much payrolls?
So I think it's both, John. It's going to be the inflation data and the employment numbers. I think the bias you're sensing comes from where the neutral rate is, the midpoint. The range is really large. But if you look at where the midpoint is, it leads to this narrative that we are very restrictive. That's where that bias comes from. Now, as you know, my neutral rate is higher than the average. People will differ on where the neutral rate is. But that bias comes because people just compare where neutral is and say, wow, we're still very far away from that.
Well, you've made the argument that things have changed. And I think a lot of people on the FOMC are yet to be convinced. Could you lay out that argument now? What has changed over the last 5 years that's led to a higher neutral rate in your mind? And why do those conditions, why are we in that regime for a long time to come?
And you've heard it from others like Larry Summers, and there's also a hint of it in the Williams interview that we mentioned earlier. First of all, it has to happen, what's happening between investment and savings. And that gap actually is getting bigger between investment and saving. The second thing is, let's not ignore what's happening on the fiscal side. And then the third thing is the fragmenting global system. The global system is structurally becoming more sensitive and more vulnerable to adverse shocks. So you put these three things together, and it suggests that the neutral rate has migrated up, and not just by a bit, but by a notable amount.
Mohammed, the language does continue to be gradual reductions. Do you think that there's a sense on the Fed that they realize that this might be the case and gradualism is necessary to end at the right point?
Danny, that's a great point, but gradualism means different things to different people. Gradualism, I think, to most of us means take small steps. You're still in the dark. The image that Chair Powell shared with us a few years ago, you're still feeling around in the dark. You're not quite sure where everything is. So take it easy. That's one bit of gradualism. And that's the bit that's why I thought 25 basis points starting in July was the right thing. Let's not do anything big, bold, because what ends up doing is it changes expectations. Look, Danny, there's a much bigger point, which is markets are all over the place. In the last, 15 days, the probability of a 50 basis point cut in November has gone from over 60% to 0. Think about that. November is next month. That is how much uncertainty there has been in this market. This market lacks anchors when it comes to how it sees the interest rate path. The whole profile of rate cuts has moved up, meaning fewer cuts by 50 basis points. These are massive moves based on data points. And until we restore some sort of anchor, you're going to have this volatility that, as you know, I worry that at some point you may expose a structural weakness somewhere in the system.
Well, when it comes to these anchors, how difficult it is to understand what the Fed views as neutral. You mentioned Williams again, and he hinted at that in the Financial Times article. He said we're, quote, way above it. What does way above it mean?
That's exactly it. They have to be careful with their words. That's exactly it. I mean, I think that there's going to be a lot written on what went wrong with Fed communications starting in 2021. And why is it that now Fed communication amplifies volatility, which is not what it's supposed to do. The whole point of forward policy guidance is to lower the overall volatility of the path. And what we are living in this strange regime where Fed communication enhances volatility. And that is something that I suspect a lot of work is going to be done on as to how not to repeat this mistake going forward.
We're lucky to speak to one of the authors of those books yet to be written. Mohammed, it's good to catch up with you this morning. Thank you, sir. Appreciate it. Mohammed Al-Erin of Queen's College, Cambridge, on the latest situation with the Federal Reserve. Just an update for you, just briefly, for those of you following the hurricane. Hurricane Milton, 7:45 Eastern time, so about 30 minutes from now, we'll hear from the Florida Governor, Ron DeSantis, holding a briefing on the hurricane. So look out for headlines from that in about 30 minutes' time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden is expected to announce a plan to replace all the lead-contaminated water pipes in the country over the next 10 years. The plan will include an additional $2.6 billion from the Environmental Protection Agency to improve drinking water, with 49% of the funds going to disadvantaged communities. He'll announce the plan today in Wisconsin. Meanwhile, Warren Buffett's Berkshire Hathaway has now sold more than $10 billion worth of Bank of America stock. This coming after a recent filing showed Berkshire unloaded another $383 million worth of shares over the course of 3 trading days. Buffett started selling shares in mid-July, putting pressure on the stock ever since. As of Monday's close, Berkshire's remaining 10.1% stake is worth about $31.4 billion. And a U.S. judge ruled Alphabet must lift restrictions that prevent developers from setting up rival marketplaces and billing systems that compete with its Google Play Store. The decision upends the search giant's dominance in its Android app market and comes after the firm lost an antitrust case to Epic Games, which accused Google of abusing its power in the market. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. I'm next on the program, bracing for Hurricane Milton.
We have made a pre-landfall declaration request from FEMA for support, and the federal government has approved a portion of our request for pre-landfall items.
A conversation up next, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures positive on the S&P 500 by 0.4%. Under surveillance this morning, bracing for Hurricane Milton.
All folks on the west coast of the Florida Peninsula should be prepared for potential major impacts. We have made a pre-landfall declaration request from FEMA for support, and the federal government has approved a portion of our request for pre-landfall items, and we expect the remaining parts of our request subsequent to landfall for debris and individual assistance once the storm hits will also be approved.
So here's the latest. Hurricane Milton approaching the Florida Peninsula as a catastrophic Category 4 storm, bearing down on a region still struggling to recover from Helene. Henrietta Trays of Vader Partners writing entire zip codes across 3 states, Florida, Georgia and North Carolina, which will likely expand to include a big chunk of middle Florida by the end of this week, are entirely without access to mail. That means mail-in ballots getting to those homes, let alone returning fully filled out ballots from those homes, just got dealt a massive blow. Henrietta is with us around the table here in New York. Henrietta, good morning.
Good morning.
Politics, of course, for these individuals right now, not top of mind. Our thoughts for the people in Florida, very much top of mind for all of us around this table. Just to consider, though, the potential fallout for this election, what could it mean?
Well, the first thing I think of is not political warfare, who is getting money from FEMA or not getting money from FEMA. It's the logistics of how do you actually go and vote. Having gone through hurricanes myself, you evacuate, you're gone for weeks at a time. Your kids may or may not even have a school that they can go to during the day for you to get away to vote, let alone go to the school and vote, which is where usually people are doing it. So I believe in Georgia, there's 47 schools that are closed now, just in that state. And you have to think that entire swaths of Florida now, from Milton, let alone from Helene, all the way through the Panhandle, are going to be cut off as well.
And you write that, at least when it comes to North Carolina, Republican voters outnumber Democrats in these hard-hit areas 2-1. So I think, what is the Trump campaign going to do in places like North Carolina? Do they put people on the ground to try to even shuttle people to this potential new polling place that's going to be because maybe the schools are still closed?
Absolutely. And in a close election like the one we have right now, the ground game is everything. So if you think of Kamala Harris and the $380 million that the campaign has been able to raise, they have field offices, 12 different ones just in Georgia, if I'm not mistaken, or Florida. And those are boots on the ground that are able to get people, new polling places, tell them where they need to go and get them to the polls on that day. That kind of ground game is what we saw turn Georgia blue in 2020, not at the presidential level, but also with 2 Senate seats. That kind of ground operation. It's critical.
And you think Kamala Harris right now is running a better ground game in these states than Donald Trump?
I think Republican operatives in those states are telling you that that's exactly what's happening. They're very nervous about it.
We've seen the former president go back to Wisconsin a number of times in the past 2 weeks, constantly making trips in and out. Is he potentially looking at chipping away at the blue wall because he's nervous about the hurricane impact in places like North Carolina?
Well, I think Florida, and especially the New York Times polling that just came out this morning, it's plus 13 in their new survey for Republicans right now. If you're going to take out the middle part of Florida plus the Panhandle, you're leaving Miami-Dade County and Upper Duval. Those are the blue pockets of Florida. You've got to be concerned about that math, especially when you're working with the ground game deficit. So going to Wisconsin, going to Pennsylvania repeatedly, sending your surrogates there like he is with Elon Musk, that is where you need to make sure you're running up the tab.
This is so devastating on a human level, so I hate to ask this question, but North Carolina, Georgia, Florida, which is going to be the worst for the former president in terms of voter turnout and Republicans?
I default to Georgia just because it's been done before. Democrats haven't won North Carolina since, 2008, but they just won Georgia in 2020, and then the referendums on abortion are critically felt there. Georgia has a restrictive ban. They just reinstalled that this week, yesterday, if I'm not mistaken. Florida's got a referendum on their ballots. This is a very critical top issue for Democrats. They're going to turn out and vote. And that's what I'd be worried about.
What is the ability for some of these states, for Florida, for North Carolina, to relax voting restrictions, to allow people to have the extra time to early vote, to extend mail-in ballot limits and deadlines? Are these states likely to pursue those sorts of things? And how much would that even help at this point?
Right. If you definitely want to give voters more time to go to the polls, especially if they've been entirely displaced. Ron DeSantis had a choice yesterday, for example, to extend the registration deadline. One of the things we heard from the emergency management teams immediately in the aftermath of Helene was that they were going to extend early voting all the way up until Tuesday, November 5th, as opposed to cutting it off on Sunday, for example. It varies by state. But what we've seen is no change out of Florida Florida, registration ended yesterday. You're not able to vote. So if you were sandbagging your house and getting ready, you're not able to register, to get on the ballot this year and make sure that you vote. But those contingencies are very easy to do. The teams are prepared for this. It's not like this is an election season, hurricane season. They know that this is when these hurricanes hit. So they have options.
On a national level, though, a lot of the coverage has been fear for the people in these places and fear that they're not going to get help from the federal government. How does that impact the election as a whole, that perhaps government agencies don't have the capabilities to do as much as so many people want them to?
Yeah, I think the first thing is that you physically can't get there immediately after a storm. But now in the immediate aftermath, we've seen President Biden call for Congress to return to D.C., pass an emergency appropriations bill. I don't think that they're going to do that. There's some talk about a discharge petition to move it forward really quickly. That's kind of a non-starter in D.C. So I wouldn't expect anything before the election. But after the election, there's going to be an opportunity for emergency FEMA designations. To my understanding, they're fully funded now with what they need. And that's the message that the White House is trying to send. But getting it out and getting it to individuals is going to be really difficult. And a disinformation campaign only complicates that further.
What's your base case now, and has it changed?
My base case with 60% odds is that Kamala Harris wins. That is based off of a declining advantage for Donald Trump in the Electoral College. I think we have a very full accounting of his supporters. So I don't have the narrative anymore, which I used to, of 2 to 3 percentage points in the polls that you should be tacking on for Trump because of the silent Trump voter. He's consistently polling in the 46, 47%. His threshold in 2020 was 47.1%. He's sort of bang on. So for Kamala Harris to continue leading 2, 3, 4 points in the latest New York Times poll that came out this morning suggests that the national average is high enough for her to win the Electoral College.
Yesterday, she sat for 60 minutes, and Bill Whitaker talked about the fact that a number of people just still don't know her.
Yeah.
Is the campaign too late in doing this media blitz this week? And we should note, besides Bill, probably the media blitz was to very friendly pundits.
Yeah, to very friendly pundits. And the strategy now is to go after these really niche podcasts and niche outlets, which I think is an interesting strategy, but probably belies that this is a really close election. And you need to turn out, you need to exacerbate the gender gap. For Donald Trump, he's going squarely after young male voters, particularly young Latino voters. I do think that there's been a lot of movement in the black voter base that's gone well back to Kamala Harris in that 85, 87% threshold, which is where they ordinarily vote for Democratic candidates. So that return is definitely happening, and you're seeing really the gender divide be what splits everything. So Kamala Harris doing Call Her Daddy was, I think, an indicator of that, going on The View this morning. And for Trump, pivoting to, very focused on the young male audience on the internet with Elon Musk, et cetera.
Henrietta, it's good to see you here in New York. Thanks for being here. Henrietta Trace there of Vader Partners. Up next on the programme, we'll catch up with Clete Willems of Aiken on potential Trump 2.0 tariff and trade policy. That conversation on the other side. Equity futures this morning up by 0.33% from New York. Good morning. Two hours away from the opening bell, equity futures on the S&P 500 up by 0.4%. On the Nasdaq 100, similar move on the Russell. The small caps up by around about 0.1. We heard from Goldman Sachs, who's got a year-end price target of 6K on the S&P 500. Goldman on a little bit early this morning, saying margins are expanding. It's a good thing. They are hopeful that this can continue, and that's why we're not seeing layoffs. Not seeing layoffs in the jobs report, seeing stellar numbers in the labour market in America.
Right, just talking about how correlated the two are, and it might be the thing that needs to support for equity markets as we start to get the earnings in. PepsiCo today cutting costs, some stress for consumers, still value conscious. We're going to get Delta on Thursday. I think that will be interesting considering some of the airlines last quarter reporting weakness. And then we get the banks. In this period of uncertainty with an election, with geopolitical conflicts, can earnings carry this equity market through to new highs?
The credit piece of the bank earnings story we're all intrigued by, particularly after the bank conference season of a few weeks ago. We heard JP Morgan, I think it was Dan Pinto, flagging what was happening with interest rates. They're set to be cut, what that would mean for profitability and net interest income. And then we heard from Ally Financial, warning essentially about what was happening in the auto loan book. Is the credit situation worsening? And are we going to see any of that at all in the bank earnings over the next week or so. Let's talk about the bond market just briefly. 4 handles across the curve at one point throughout yesterday's session. The 2-year back to about 397. The 10-year, that move sticks, 4.0275%. This note just dropped in my inbox from SocGen. Foreigners are piling into US assets again. Do you remember that big conversation that rates were coming down, that people would look elsewhere, the money that had come into America, Danny, would go back out again?
Well, it's part of the reason that you also saw a curve flattening, because all of a sudden, long end yields look rich and, hey, I can jump back in. Of course, the fear is that if inflation risks are back in the table, that it doesn't stop at 4%, that it continues to go higher, and that reinvestment risk actually turns into a risk that you get hurt on your bond market position. It's all things to play for as we wait for CPI on Thursday, but certainly the conversation has changed after Friday.
This has consequences for the FX market. Euro dollar breaking 110 in the last week or so, 109.80, just about firmer on the session. Considering what the Federal Reserve may or may not do on November 7th, we have to keep going back to the fact that there is an ECB meeting this month. And the ECB is now open to an interest rate reduction in a way that maybe they weren't a month or so ago. The data out of Europe just has not been great. Euro dollar, 109.80. Under surveillance this morning, Florida, bracing for Hurricane Milton. The historic storm expected to make landfall Wednesday evening or early Thursday morning. Governor Ron DeSantis declaring an emergency in 51 counties. Officials urging anyone in the Tampa Bay area to evacuate.
I actually spoke to the DeSantis office yesterday, and they were talking about how the governor's basically in the emergency room for 24/7, directing what is happening at the state. They were viewing a hurricane like this to be potentially that black swan event, and it might be upon them. Henrietta Trey talked about the fact that FEMA has the money, especially given this moment in the political cycle where everyone is trying to throw darts at FEMA. But FEMA, in their own briefing yesterday, spoke about the fact that when it comes to personnel, they only have 9% left. That's about 1,200 people. Potentially, they're going to have to go to contractors. They're going to have to go to other parts of the U.S. government to make sure that they can get personnel on the ground if they are looking down at this hurricane, which is potentially going to be absolutely devastating for Florida.
Is this a FEMA that's ready for the new normal? The new normal of extreme weather, not just hurricanes, but part of the reason they're under stress is that just earlier this year, they had to contend with wildfires. They're already starting to feel the stress even before you get to Helene, even before you get to Milton. It's not even that. It's things like the Small Business Administration, their ability to provide loans. Biden said on Friday in a letter to Congress saying that they will run out of funding in a few weeks. It just feels like these government agencies are not set up in a way where they can continue to deal with these natural disasters.
I think we have to really lay out that this was the ultimate fear, to get a 1-2 punch following Helene. And the second punch, it didn't really matter what that punch was like because things were so devastated, so underwater that anything, any kind of storm in any way, shape or form would have been devastating. For that second punch to have the kind of power that we're talking about from Milton, it's just brutal. I don't know what other way to put it right now for the people of Florida, particularly in Tampa.
Resources are so thinly stretched right now when it comes to the government response, which is why President Biden was saying to Congress, you might have to come back. We might need more supplemental funding. And Speaker Johnson says, I'm not calling anyone back at the election year. Looks like they will have the funding to get on the ground aid. I still worry about this idea of personnel. And also, once power lines go down, once broadband goes down, how do you even call for help? Let alone, we talked about Henrietta Trey's, how do you go out and vote come November 5th?
Following the latest out of Florida throughout this morning, just to mention once again that there is a briefing from Governor Ron DeSantis in about 10 minutes' time. We'll bring you some of the headlines from that as we get them. I want to turn to this story. Israel's defense minister is set to meet with U.S. Defense Secretary Lloyd Austin in Washington on Wednesday as the world awaits Israel's response to Iran's missile attack just last week. President Biden has urged Israel not to attack Iran's nuclear facilities or energy infrastructure. We've been waiting, bracing for the last week or so.
Well, I think you can imagine and read into the situation right now, given that we have the Israeli Defense Minister Gallant coming over to Washington, that they're going to wait on a response until they brief the White House. What I'm hearing, talking to a lot of people right now in Washington, D.C., is that we can expect measures actually out of the White House when it comes to punishment towards Tehran. This would likely mean sanctions, but they're not going to do anything yet until they understand probably what Israel does, because the idea is that they would do this in conjunction with Israel's response. So a lot of things feel like they're on pause right now until these critical conversations happen.
But how forthcoming will Israel even be with their plans? I mean, we're coming from a period where the White House was left in the dark by some of the things happening in Lebanon. And the White House, according to Axios, had a report out this morning that they simply no longer trust that the Israelis are going to tell them what's going on. So what's the ability of the White House to say, Please don't attack oil infrastructure, especially in the middle of an election year. And what's the ability of Israelis to even tell them what they will do? I think the relationship feels as if it's somewhat frayed after recent action.
Crude's had a big run off the back of this story, breaching 80 for the first time since August in yesterday's session. That's the latest of the commodity market, the latest in the Middle East. I want to bring you the latest out of the tech world. NVIDIA production partner Hon Hai planning to boost its server capacity to meet what it calls crazy demand for NVIDIA's chips. Hon Hai is building the world's largest assembly plant for servers in Mexico. They're home to NVIDIA's most advanced grade Blackwell chips. The demand off the charts.
It is off the charts, and if you miss, you are punished. I wasn't just captivated by this story, but of Samsung this morning. They literally issued an apology for bad results. And the bad results were because they didn't have the capabilities to keep up with the AI demand, that they're not matching some of the other chip manufacturers. They said that they confessed to delays, that these are testing times, that according to the head of the semiconductor business. So while there's this big promise of AI, if you miss, it really hurts from these companies, and again, leads to someone literally issuing an apology.
The tentacles of this story reach far and wide. This from Google, working with utilities in the US and other countries to assess nuclear power as a possible energy source for its data centers. Not the first time we've heard this kind of thing. Saw it from Microsoft recently as well. But that's how much demand is building in the system.
Insatiable demand for the chips, because you want this insatiable demand to compute, and for that you need a ton of power. What I'm struck is that these tech deals seemingly are able to turn on power, like nuclear power, that you've seen progressives and even this administration try to do for the past 3.5 years.
Private solutions, always. The private market coming up with the solutions. Let's turn to the election. Campaign pledges from Donald Trump and Kamala Harris on tariffs and government spending, drawing a range of reactions from economic experts. Clete Williams of Aiken, who served as the deputy director of the National Economic Council under President Trump, saying this about potential Trump 2.0 tariff and trade policy. Expect a higher tariff climate. You will see much more targeted action on specific countries and issues. Also expect a much greater potential for deal making. Clete joins us now for more. Clete, welcome to the program, sir. You were part of the last Trump administration, and we remember it well. Of course, we were talking about reciprocity, and the argument being presented was a clear and obvious one. It made a lot of sense. There were tariffs being put on America that we weren't putting on others, China, and we should ultimately say to them, if you don't drop them, we're going to put them on you. And that's what was happening. Clete, I wonder how the strategy from your perspective has shifted. Are we looking at a new approach from an incoming president potentially with Trump 2.0?
Well, I really appreciate that introduction, because you nailed it. And the reality is that the United States has had much lower tariffs in place for a long period of time than the rest of the world, and especially our largest competitors. And that all made sense in the wake of World War II. We were trying to help Europe rebuild. We wanted to show leadership. But over time, we haven't updated that system. And just to give you two tangible examples, right now our average tariff rate is around 3.5%. If you look at China, they're around 7.5%. And if you look at someone like India, they're up over 18%. And so I think what President Trump was saying back in 2017, and he's saying again, is we need to get better reciprocity. Now, in terms of the strategy, does it differ from last time? I mean, I expect a lot of the same. As you alluded to already, we're going to get the return of the tariff man. And I think that there is going to be efforts to use tariffs to create greater reciprocity, to get deals, to promote investment in the United States. But I also think you're going to have a lot of deal making. You're going to have a lot of efforts to open up markets abroad, which is something we haven't seen from the Biden administration. So I do think you're going to see a lot of the similar approach. But, the world has changed over the last couple of years. And I do think that maybe in some sense it'll be even more muscular than last time.
Clete, do you think a 10% tariff ring around the United States and 60%, what Donald Trump is calling for Chinese imports, is reciprocity?
Well, I think the idea on something like 10% or 60% is really to make sure we can equalize international trade. And look, we're hearing things that he's saying in the campaign. And what a lot of the advisors will say, and what I believe to be true, is this is a work in progress. And we'll see exactly how that is implemented. So 10% may end up manifesting itself as a 10% around the globe to start a negotiation. There could be instances where that goes into place. I mean, it all depends. Like I said, if we put 10% on India, we'd still be lower than them. When it comes to China, what I do expect that a Trump administration will do, or at least should do, is look at enforcing the phase one deal put in place tariffs to make sure China's following through, and then go from there. And maybe you have a potential for a deal there as well over a longer period of time.
What I'm hearing from you is that potentially this is an opening salvo when it comes to trade if the former president is back in the White House. How much can he do unilaterally versus how much does he need congressional support for?
Well, it's pretty clear the courts have given the president a lot of leeway to target individual countries, something we did before using Section 301 on China. The courts have also given him a lot of leeway to target individual products, something we did before using Section 232 on steel and aluminum. Where there's a little bit more ambiguity and where this is a little bit untested is when you go to this across-the-board kind of proposal. And there's some precedent here from 1971 where President Nixon put in place a surtax, but that was temporary. It didn't apply to every single product coming into the United States. So we know the president could do something more on an across-the-board basis, but I think it really is going to come down to, does this apply to every product? Does it exempt FTA partners? Does it exempt intermediate goods? Those are the kinds of things a court might look at and try to determine whether the president can do this. But let me take a step back. I do think a big part of the Trump policy that hasn't been discussed is working with Congress. Trade has become a much more bipartisan issue, and I do think that there will be attempts to work with Congress to give the president authorities that he doesn't have today.
Clete, there was a report by the Committee for a Responsible Budget earlier this week that said through 2035, it expects the federal debt under a President Trump to swell by $7.5 trillion just because of things like lower taxes, tariffs, immigration policy. For Harris, they said $3.5 trillion over the same period. Do you think that there will be a willingness to try to rein some of that in, or how much do you even pay attention to predictions?
So again, I'll take that with a grain of salt. This is looking at campaign pledges. A lot of these campaign pledges are going to require Congress. And so I don't think either president can unilaterally impose the taxes or spending that they want. That said, I do take a little bit of an exception with this. I do think it makes some assumptions that are inconsistent with President Trump's track record. Just to give you one clear example, last time when we were enacting tax cuts in 2017, those were fully paid for. And this report assumes that they wouldn't be. I think this report also overlooks that in the past, President Trump was able to work with Congress to try to rein in domestic discretionary spending, and I expect that to happen. And then lastly, I think from a bigger picture, reports like this constantly underestimate the growth impact of these policies, and the fact that when you enact competitive tax policy, you cut regulations, you have a better energy policy, things like that grow revenues overall. So I'm not saying tax cuts pay for themselves, but what I am saying is there is a feedback that is not captured here, and we saw that last time the president cut taxes with Congress.
So growth helps pay for some of it, maybe not all of it. Where did you see the rest of that revenue increase coming from?
Well, I think that both parties need to do a better job on fiscal discipline. I'm not going to argue with you on that. That's not the kind of thing that a lot of people are spending time on in the campaign. But I do think that will also be part of the equation here.
Clete, one dimension of all of this that I'm fascinated by and would love your input on is Mexico. I think the China story is pretty well understood. What do you think is going to happen with Mexico? What's going to be the approach?
Well, look, there's going to be tension with Mexico regardless of who wins this election. And folks may recall that there was a novel review provision in the USMCA trade agreement where we have to decide by the middle of 2026, do we want this thing to move forward? And that's going to create a negotiation with Mexico. And there's lots of concerns about what's going on down there, starting with the judicial overhaul, which a lot of people think has undermined some of their judicial independence. They're also seen as a backdoor for a lot of Chinese products. That Chinese products can come into the United States through Mexico. And of course, you've got issues on immigration. So I think all that's going to come together. And I do expect that it will be a little bit combustible. And I will tell you, though, I hear the folks in the Harris orbit, the current Biden people, raising a lot of the same issues as Trump. So I think this will be contentious regardless of who wins.
It's one to watch. We'll do a deeper dive next time. Clete, appreciated catching up. It's good to see you. Clete Williams there of Aiken on the latest situation. And a situation to anticipate with countries like Mexico. I think Mexico's the one to watch here.
I think it's really interesting as well, because Clete was talking about the fact that there's this provision in the USMCA, because potentially the way Trump is talking about Mexico, and he mentions things like John Deere with a 200% tariff if they make products in Mexico. It feels like he's almost willing to rip up that trade negotiation that he got to the table and ended up making a deal with. Also, Cleet is absolutely correct when it comes to EVs in Mexico, made by China. Both Kamala Harris and Donald Trump do not want those vehicles entering the United States.
Want to keep on the radar, big time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Japan has recorded the highest number of bankruptcies in a decade as companies were increasingly hit by rising costs. According to a local report, nearly 5,000 firms went bankrupt in the 6 months through September of this year. That's up nearly 19% from a year ago. Construction, manufacturing, and retail were among the sectors that had the highest number of bankruptcies due to pressure from inflation. Meanwhile, iron ore and base metals are falling after China's top economic planner failed to announce new stimulus measures. Investors were bracing for another boost in government spending after a week-long public holiday, but didn't get one. Still, iron ore futures are up from late September on optimism that China's earlier moves to boost the economy could provide a lift for the country's struggling steel industry. And you touched on this earlier, the AI boom has big tech eyeing nuclear. Google is in talks with utilities in the U.S. and abroad to assess nuclear power as a possible energy source for its data centers. But Google's not alone. We've seen other tech titans like Microsoft and Amazon already betting on nuclear energy as a source of power to meet the surging electricity demand created by their data centers. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, bond yields back through 4%.
We were advising clients, hey, if you ever get an opportunity to buy the 10-year, in that 4 to 4.5% zone again, don't miss it this time. Take advantage of it. And right now, we're right at the bottom, of that buy zone.
We are in that zone. That conversation up next. Equities on the S&P 500 firmer by 0.4%. Under surveillance this morning, bond yields back through 4%.
A month or two ago, when the 10-year was pushing down at 360 and there were tons of rate cuts priced in, it seemed like a little overdone. We were advising clients, hey, if you ever get an opportunity to buy the 10-year, in that 4 to 4.5% zone again, don't miss it this time. Take advantage of it. And right now, we're right at the bottom, of that buy zone is what we're calling it, right? And I think, investors are probably going to take another bite at the apple here.
So here's the latest. Treasury yields hitting 4% for the first time since August as investors fade rate cut bets. Christina Campbell of Invesco writing 4% yields will garner interest, but we expect a continued drift higher in longer end rates towards 4.25 and possibly even 4.50 as the market reprices towards a higher terminal rate. Christina joins us now for more. Christina, good morning.
Good morning. Thanks so much for having me.
In the buy zone, according to PGIM, but you're not a buyer.
Look, you're starting to get there, but I think the clearest opportunity in the market is still that you have this steeper curve. So there's value in the front end. You have 2-year notes at 4%, and you have 10s at 4%, and there's a lot more clarity in the front end. And I think you have to think about a soft landing means that terminal rates should be higher, and we have to adjust for that.
A major wrinkle's been introduced in the past few weeks. Hurricane Helene, Hurricane Milton. How are you and the team thinking about that? The price pressure we could see in the months to come, what it could mean for growth, what it could mean for some very messy jobs reports as well in the next 30 days.
So I think even we came into September with the market really just focused singularly on the labor market, and last week's really stellar payroll report brings back into focus, do we have to be concerned about CPI and inflation impacts? And I think there will be focus there this week for sure. And then the hurricanes, as you said, just bring in such an element of noise because you have the initial, we missed the real negative impact from the port closure, but you have a stop of economic activity in the regions that are hit, and then you have a pause and a real rebuild effort. So there's this stop and go. There will definitely be noise to payrolls in the next couple of months as a result, I'm sure.
The other shock that we're bracing for is what happens to oil, what happens to geopolitics. How tied do you think yields above 4% and $80 a barrel on Brent crude are?
I think they're definitely connected. So when we say, like, we think soft landing is the base case, and the two big risks out there are exactly this. It's Middle East tension and what are the oil impacts and the follow-on potential inflationary risks there. And then, of course, the storm impacts, primarily like what is the human impact and then what is the follow-on economic impulse. So those are things we're certainly keeping an eye on. And I think the Fed is too, and they have this concern and they're waiting and they're reacting to all of this data in real time. I think the market on the back of Friday wants to say like 50s are off the table and we swing the pendulum again. I think Powell's language so far has been guarded of we want to keep all the options in our pocket and we'll respond when we're ready and when we have that information. And so many things can change between now and November 7th.
What do you make of this idea of more people talking about this no landing? The plane just continues, bigger but not hotter. What would that mean for the bond market?
Look, we look at it as a soft landing as we're already in the midst of it. Like, you have seen inflation coming down. You are seeing a return towards trend growth. But I think this dynamic means that we also have to have a higher terminal rate. If we have a mid-cycle adjustment or the Fed needs to ease 150 basis points and then take a pause and reassess and say, what do we need to do? Then 2's curve shouldn't be at 0.
So you've got to run a portfolio. What are you buying? What are you doing?
Yeah. So look, we still think that we have a backdrop for a broadly weaker dollar, although there will be some challenge there as other central banks pick up. And there's some divergences that there are, like the Bank of Japan, Bank of Brazil, that are actually on the contrary. Within rates, again, I think there's front-end paper offers value. Corporates have been tight, but continue to perform because you have a backdrop of solid growth. Mortgage paper, we think, looks interesting as well.
Christina, appreciate it. It's good to see you.
Thank you so much for having me.
Thanks for catching up with us. Difficult few months ahead, I'm sure. Christina Campbell of Invesco. Coming up on this programme, very shortly, we'll catch up with Ross Mayfield of Baird, Pierre Andurand of Andurand Capital Management on what's been happening in this oil market. Look out for that conversation. It will extend to other commodities as well. Tom Porcelli of PGIM Fixed Income joining us on the other side, and Mark Cabana of Bank of America. A stellar lineup for you in the third hour of Bloomberg Surveillance. Equity futures on the S&P 500, positive by 0.4% near session highs. In the bond market, still sticking with a 4 handle on a 10-year yield, 4.02% at the front end of the curve, breaking 4% yesterday, but coming back below that level. We're down 3 basis points at about 397. And as we tee up that conversation on the commodity market, crude backing off, we're down by 2%. A break of 80 yesterday for the first time since August. We're back to 79.24. From New York City, this is Bloomberg.
Bullishness in the top of the market is starting to filter down.
You're seeing stocks and bonds are trading uncorrelated, more like the pre-COVID period.
Investors are probably going to take another bite at the apple here.
The health of the stock market's going to depend on earnings.
I think the market can continue to broaden.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Your morning in the United States of America looks a little something like this. The highlight at 9:30 Eastern Time on Bloomberg TV and on Bloomberg Radio. Jamie Dimon of JP Morgan, the chairman and CEO, sitting down with Bramo. Lisa Abramowitz hosting that conversation for 30 minutes. It's must-watch TV. Do not miss that at 9:30 Eastern Time. That's your morning ahead. Here's your week ahead. Shaping up as follows. CPI, the big one. It comes on Thursday. Fed minutes coming tomorrow. Look out for that. Then on Friday, we can stop talking about the data and the Federal Reserve. We can talk about earnings. JP Morgan and Wells Fargo just around the corner. Into all of that, equity futures bouncing back on the S&P 500, up by around about 0.4%. On the Nasdaq 100, up by 0.5. Danny bouncing back from yesterday's losses.
One of the notable things about Friday and the strong labor market data is it means that this market is concentrating more than just on a recession risk. It's concentrating on inflation risk, it's concentrating on oil and geopolitics and an election. It's a time where maybe the runway for this market is much more limited because of all those uncertainties. And again, removing jobs is a thing that's going to catalyze this whole market into praying for another 50 basis point cut. Having that off the table means that there are more worries to contend with.
We mentioned this moments ago, a major wrinkle, a major worry, and it could be with us for a number of weeks, perhaps even months. Hurricane Milton barreling down on the state of Florida, a state that's already trying to recover from Hurricane Helene. things could be a lot worse. We need to work out from an economics perspective what it means for growth, what it means for price pressure, what it means for the jobs report in a month from now, what it means for how Federal Reserve is going to set policy. It's going to be very difficult to do all those things.
It's very challenging because obviously these are going to be all different moving inputs on how the hurricane is going to impact not just Florida, but these 5 states in the southeast of the U.S. Very challenging when you look at the labor market. And also, Jonathan, we have to talk about what it means also potentially how this could shape November 5th. And what it means for some of these counties that normally would vote Republican.
Henrietta Trace of Veda Partners was with us earlier on this morning. Go through some of the stats that she'd laid out, the difficulty that we're going to have getting to actually vote in this election in places like Florida.
And places like if you're in a hurricane, you decide you have to evacuate. You're being told you have to evacuate. You might leave Florida entirely, and you might not be going back until after the election. What does that mean for potential mail-in ballots? Some of these places, your local school will not be open on November 5th. And what Henrietta was talking about is how Kamala Harris is actually running a really good ground game right now in these states because they have the money to do so.
17% of the critical battleground state of North Carolina is currently in a FEMA-designated disaster zone. More on that, of course, through the next 24 hours or so. Coming up in the next 60 minutes on this programme, we'll catch up with Ross Mayfield of Baird as China's stimulus pledge fails to impress markets. Pierre Andorand of Andorand Capital Management following a 5-day rally in the oil market. And Mark Cabana of Bank of America as they drop their call for another 50 basis point rate cut. We begin this hour with stocks little change following the biggest one-day loss on the S&P 500, going into inflation data later on this week. Ross Mayfield of Baird seeing opportunity writing this. It's hard to describe the macro backdrop as anything but bullish. Political and geopolitical tensions may cause volatility to remain elevated, but we'd be buyers on weakness. China is a wild card, but a potential global growth tailwind. Ross joins us now for more. Ross, welcome to the programme. The biggest one-day loss on the S&P in about a month in yesterday's session. We're bouncing back just a little bit on equity futures. A big conversation so far this morning is about how we're going to navigate the impact, the damage done by Hurricane Milton in the next 24, 48 hours. What will your read be on that for things like growth, inflation and policy of the Federal Reserve?
I think one of the things that's going to be really challenging is the job data that the Fed relies on is going to be, it's already increasingly revised, and there's some questions about collection and the quality of the data. And this sort of thing introduces a major wildcard into things like initial claims data. So it's going to provide a challenge for the Fed at a time where we're kind of at a critical juncture here. I mean, the direction of policy is laid out, but the speed and the magnitude is not. These are critical states for economic growth. The South has been a huge driver in recent years, and so it presents a challenge. It's something that not just we have to work through for Milton, but probably for years to come. I mean, this sort of thing is increasingly likely. It has spillover into insurance markets and property markets and things that really need to be digested, not just for this year, but for the coming decades.
And yet, Ross, it feels like there is a bias to reduce interest rates. John Williams, the New York Fed president, was speaking to Colby Smith in the Financial Times, said the following: inflation, if it falls even faster than expected, that would call for policy to normalize a little bit more quickly. If inflation stalled, he went on to say, that would call for interest rates to come down more slowly. What do you make of that bias to reduce interest rates?
I think it makes sense. I mean, you have a neutral or a rate that's well above what the Fed views as neutral. You have inflation that's come down to somewhere between 2% and 3% by most measures. You have a job market that, we got the nice report last week, but that's a noisy data set. And the general trend in the labor market is cooler. So it makes a lot of sense to try and get back to neutral. I would do that quickly. I don't think we're going to get 50 in November, but I don't really see why you wouldn't move quickly towards neutral and then give yourself the flexibility in either direction for how 2025 and 2026 play out.
Well, still, Ross, you have maybe that certainty that the Fed has a cutting bias, but there are huge swaths of uncertainty beyond that. We already talked about the hurricane. There's geopolitics. There's an election. As we navigate these periods of volatility, how do you distinguish between dips you want to buy and those that you don't?
Well, I do think you have to look at the biggest, broadest macro backdrop to kind of get a sense of whether it's viable. I think rates coming down for the right reason, which is inflation has cooled meaningfully. You have the earnings backdrop, which is still quite solid and inflecting higher. We'll get a lot more data on earnings over the next couple of months here. But really, you have an economy that's growing pretty solidly. You have a consumer that is still spending based on a labor market that, while it has cooled, is still historically strong. And you have interest rates coming down alongside inflation. So all in all, it's a very solid macro backdrop. And so when things like geopolitical volatility or domestic political angst pop up, those are things that don't impact, how we view the next 2, 3, 4 years. And so we'd be buyers of weakness there. The overall trend of the market is still quite good as well from a technical perspective. You have a lot of stocks above their 200-day. You have a kind of a breadth narrative, right? Not just big tech anymore, but a lot of other sectors working. So the overall backdrop looks really strong to us. And so any kind of weakness that is political related, we'd be buyers of.
How do you understand how that breadthness is going to evolve as we head towards the end of the year and next, Ross? Do you see leadership shifting as it already has started to away from tech and into something else?
Yeah, I mean, it's a rates trade, right? You have interest rates coming down and a lot of now confidence that the Fed is going to continue to deliver those rate cuts, whether that's misplaced or not. So you have things like cyclicals working on lower rates. You have things like small caps working. You also have yield proxies. Utilities have been quite a strong performer, although that's a power play as well. So it's broadening. The market is picking up the slack where big tech is taking a breather, even though we're still, believers in the secular growth themes of AI and big tech over the long term. And it's not just in the U.S., right? Other markets worldwide are working. The China impulse has been really, really strong over the last couple of weeks, and that has spillover effects into other countries that rely on, China growth to kind of stimulate local economies. So the breadth story is really impressive. It's something that we'd been hoping to see for a lot of the last 18 months. And now that it's finally here, we want to lean in.
Just on the point of China, Ross, it was a market today that was disappointed by the NDRC, that you just had a reiteration of current stimulus and nothing that was given further to this market, nothing that looked like another bazooka. Do you share that disappointment?
Maybe a little bit, but at a certain point, if you're going to be a buyer of Chinese equities than the China story, there has to be more to it than stimulus, right? There has to be genuine organic economic growth. There has to be a remedy to some of the debt and property issues that they've been dealing with. I don't know that there are near-term solutions for that can be leveled from a policy level. But the move in the equity market signals that investors believe this is real, that there could be a real economic growth kind of reversal here. I think I'm inclined to believe the market there. It's under-owned, for a lot of the last couple of years. People have been talking about, is China uninvestable? So there's a lot of money that's flown out of Chinese stocks and into other, peripheral nations. Japanese stocks obviously have been a big beneficiary over the last couple of years. So it's under-owned, under-positioned, big momentum boost. And, I do think that a lot of the policy levers that have been pulled will have an impact on growth over the next couple of years. But you do have to believe in the organic growth story if you want to be a long-term holder of these names.
And Ross, as you know, there's been a long list of reasons not to buy China. A long list of reasons right now to wait and to sit in cash and do nothing and wait for some of these issues to resolve themselves, to wait for clarity. Ross, what's your message to those individuals this morning, perhaps paralyzed by the risk that's on the horizon, the election, the impact of a hurricane, all of these issues lining up? What's your advice to them this morning?
Yeah, I mean, our general message is that the world is an uncertain place and it's never been a certain place. And yet here we are right around all-time highs, particularly with domestic political volatility waiting until after the election. I mean, we can recall even just 2016 and 2020, big rallies immediately after the election, all of this angst going in and big rallies immediately after. I mean, to the point that the 2016 election day marked a low, the market never reversed back to there. Same with 2020. So, we'd be leaning in, buying at all-time highs, buying with strong breadth and momentum are something we want to do. And if the bull market were to end today, it would be historically short and historically weak in terms of total return. So we still think there's plenty of legs, things look a little more mid-cycle, but there's plenty of legs to this bull market. There's plenty of drivers for that bull market. And we'd be leaning into any kind of volatility, which, volatility is the price we pay for the access to these gains. So it's something that investors need to get accustomed to.
Ross, appreciate it. Ross Mayfield there of Baird on the latest. This phrase I keep hearing after the election. When does the election end? November 5th, November 6th, November 7th? Does it go on a week, a month, 2 months into a new year? When does it finish?
It's a fantastic question. We don't know. But when you see places like Pennsylvania and Georgia having to hand count ballots, it's going to take a lot longer than that night unless there's a massive blowout by someone in other states.
Could be contested. as well. It's something we've all got to think about in the next few months.
And then how does the market trade on a contested election? Have investors even decided to think about that? You talk to these market participants and they say, well, the market can only focus on the thing that's ahead of them, the next catalyst to drop. Has anyone even thought what that would look like to this market?
Yeah, not good. We're up 1/3 of 1% this morning, but I imagine that's not where we'd be off the back of that story. Up 1/3 of 1% on the S&P 500. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Hurricane Milton is approaching the Florida Peninsula with wind speeds up to 155 miles per hour. It's expected to make landfall tomorrow night with intense winds capable of collapsing homes and triggering power outages that could last anywhere from weeks to months. The storm coming less than 2 weeks after the southeast was hit by Hurricane Helene. Meanwhile, the Wall Street Journal says Honeywell is expected to unveil plans to spin off its advanced materials division. The new business could be worth more than $10 billion as a separate public company, according to sources cited in the report. Honeywell hopes the separation will give it more financial flexibility to pursue deals and other opportunities. Meanwhile, PepsiCo shares are falling in the pre-market after the company trimmed its revenue outlook for the year as demand for its drinks and chips fell. The maker of Lay's and Lipton teas is struggling as consumers rein in spending and trade down to cheaper store brands. And they see that pressure continuing, saying in a statement that consumers will remain value conscious. Despite that, PepsiCo is still expecting earnings to grow by at least 8% this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, the Morning Calls Plus, Pierre Andarand of Andarand Capital Management as Brent snaps a 5-day rally on the back of a disappointing China stimulus push. That conversation just around the corner. Equity futures on the S&P 500 firmer here by 0.4%. The opening bell 1 hour and 15 minutes away. A conversation about crude coming up. We're down by 2% on WTI, 75.51. Time now for some morning calls. First up, Wolfe Research upgrading Wells Fargo to outperform, expecting upside from the bank's asset cap liftoff. We're up by 1.5% there. Next up, Oppenheimer downgrading Microsoft to perform, citing overly optimistic revenue expectations due to OpenAI losses. We're positive there, or rather negative by 0.25%. And finally, RBC Capital raising its price target on Tesla up to T36, expecting shares to benefit from the company's robo-taxi event on Thursday. Plenty of coverage on that story later on in the week on this show. We're up by 1% in the pre-market. Turning to commodities, Brent falling below $80 a barrel as China holds back more economic stimulus measures. Metals, including copper and iron ore, slumping, wiping out most of their gains since Beijing's initial policy measures announcement just last month. Joining us around the table, Pierre Andarand of Andarand Capital Management. Pierre, good morning. It's good to see you.
Good morning. Good to see you.
Let's start with this oil market because it's confusing a lot of people. We've had some people come on this show and say there's a threat of dropping to, say, the 50s, maybe even the 40s. Others saying triple-digit crude just on the horizon. How are you thinking about this, and are you positioning bullishly for this story?
So basically, I think there's no medium-term structural trade for crude. I think the market is quite balanced, where we have still relatively large non-OPEC supply growth coming for the next 2 years, and demand growth slowing down. So it gives a bit of a bearish bias to crude. But against that, we have the largest short ever in terms of spec positioning in the market. And non-OPEC supply growth has disappointed relative to expectations. So we're expecting 1.1 million barrels a day of non-OPEC ex-US supply growth this year. We're getting at 400,000 barrels a day. Next year it's expected to be 1.5 million barrels a day. It could well be 1 million barrels a day lower. So I would say overall, the market doesn't need more OPEC oil for now. And so when they speak about bringing oil back over the next few months, it puts some pressure on the market. But against that, we have geopolitical risk with clearly, we are waiting for Israel's response to, the Iranian attacks and generally the axis of resistance attacks on Israel. So that could impact the oil market quite significantly.
What's your base case, your overall conclusion? Would you say the risk is for higher prices and not lower ones, at least in the short term?
I think in the short term, the risk is for higher prices, yes, because inventories are low. the market has been trading on next year's balances, but it's hard to get much confidence on those. And spec length is at all-time low, and we have lots of supply risk potentially in Iran.
Pierre, how high? Because in 2023, you had a call of $140 per barrel in oil. What could this geopolitical risk push it up to?
So it really depends. So let's say if Israel blows up the oil export facilities of Iran, so basically we would lose 1.7 million barrels a day, which out of a 100 million barrels a day market is important, but not too much of a game changer. Saudis and UAE and Kuwait and a few OPEC countries could increase production to make up for it over time, but it would actually tighten the market and bring prices up. Then the question is, how would Iran react to that? Would they, they said that they would blow up oil facilities in the region, in Saudi Arabia and UAE and all that. So would they do it or not? I mean,
But is there a range? We're talking about $80 where we are now? Or we're talking about 100 or 120?
I don't think. I think maybe like $10 to $15 higher. So I'm not calling for much higher oil prices, but I think there are more biased to the upside. I mean, the average price last year and this year for Brent has been around $80 a barrel. That's like we are just under that now, so it would make sense to be a bit higher at least than the average.
You mentioned OPEC. Do they need to keep the cuts in place throughout 2025?
That will depend. I think they will only bring oil back if it's needed. I don't think they will push it on the market. Saudis might threaten to do so in order to keep a few members in compliance. But I don't believe that they will go for a market share story and bring a lot of unneeded oil back. So I think that's why I don't call for much lower oil prices or much higher. But I think in the short term we could go $10 to $15 higher.
We've talked a lot about supply. When it comes to demand, you have still a strong American labor market. You have Chinese stimulus. How do you understand the evolving picture of demand?
So basically, you have to look first in the long term. So from 1986 to 2019, demand was growing pretty much in a linear fashion, growing by 1.2 million barrels a day per year. And then obviously after COVID, we lost a lot of demand. It recovered most of it since. And due to EVs and biofuels, that demand growth should slow down, probably be around 800,000 barrels a day over the next few years. Eventually, demand should reach a peak within the next 5 years and I think be relatively stable and then start declining slowly. So demand shouldn't really push prices, up too much. But then it's always going to be, like the equation is the growth of supply versus the growth of demand. And demand is still okay for now. There's no issues with demand. But it's not going to grow very strongly, but it's still growing.
We were talking about sort of the long-term 5-year picture of what EVs does. In the very short term, it's a market that is upset that it didn't get more stimulus from China today. The already existing stimulus that's in there, assuming that's where we stand and that there's no more added, how much does that add to the physical demand? How does that actually show up?
So basically, this year we grew by around 800,000 barrels a day demand relative to 1 million barrels a day expectations. It's really China that came much below expectations. So the stimulus and the economy doing better in China should bring us back towards expectation or slightly higher. But it's hard to put a number on it until we see all the details. So it sounds like we'll have more details probably just after the US election results in early November, where the NPC is supposed to speak about really the fiscal stimulus. And the market was expecting 2 to 3 trillion RMB of stimulus. Today, the NDRC didn't speak about it because the NPC is supposed to be the entity speaking about it. So we might know more in a month's time, but the market is a bit impatient and selling off on the lack of news.
So equities in Hong Kong got absolutely hammered. Copper's pulling back a little bit over in London on the LME. We're 10% off the highs of the year on copper. We got to those highs back in May of this year. Are you still long?
Yeah, I'm still long copper because the long-term story for copper, the structural story is very clear, where we have mining supply is supposed to peak within the next 2 years. Against that, we get an acceleration of demand growth due to the electrification of the world. And inventories are still low. So, we get a lot of bearish news on China in terms of construction, but construction only, like copper demand construction represents only 20% of the, I mean, it's still large, but it's 20% of copper demand in China. It's not 80%. So there's a lot of other, parts of the copper demand that is growing really strongly in China.
We got close to 11K on copper earlier this year. Felt like a big number. What kind of numbers do you think we have to get used to in the copper market, given the multi-year trade that you're thinking about?
Yeah, I think it's, demand should over time not be, very price sensitive. So sometimes it's price sensitive in the short term where you get a deferral of demand like we saw in China in Q2. But it's not like the total level of demand, over the year is going to change. It's just a deferral of demand. So I think, copper is a small market. It doesn't represent, so many dollars, in terms of the global economy. So it shouldn't be, and it's needed. I mean, you need copper to actually electrify the world. You can't really do without. And the fact that it takes, at least 7 years to bring new mines means that, like in the short term, there's no real, you can't really do much about the supply. You get some short-term fixes, are getting more scrap, but that's only for a few months. So basically, I think the demand should be relatively inelastic, which means that in order to get the demand response, you need to have basically much lower demand growth than what we need. We need much higher prices. So for me, I think it's copper prices could go up by a few multiple, by 2, 3, 4 times over a few years. So from 10,000 to 30 or 40,000. Not this year, right? But over a 4-5 year horizon, it could.
Pierre, in June, you exited some of these oil trades. Sounds like you're a little bit more interested in oil now, given the volatility going on. You were bullish on copper. What about cocoa? Because that's something else you were saying that prices were going to move higher.
Sure. So in cocoa, we had a massive deficit this year that represents around 10% of world's demand. So it's as if we had a shortfall of 10 million barrels a day of crude oil, and believing that things will get better. But clearly, cocoa is a different market from crude. I mean, every year you get new production. But basically, we had inventories, are at very low levels. It's similar to the late 70s. If you look at inventories to demand ratio, we're back to the late 70s kind of levels when cocoa was between $15,000 to $28,000 a ton in terms of today's dollars.
Yeah.
And next year, so it all depends if next year we're going to have a deficit or not, and we'll know more over the next few months. But
it's up this morning by about 2.5%. Pierre, it's good to see you. Appreciate it.
Good to see you.
So the world tour of commodities with Pierre Underrand of Underrand Capital Management. Up next, we'll catch up with Tom Porcelli of PGIM. $60 minutes away from the opening bell, equity futures on the S&P 500 with a bounce, a little bit of a lift. We're up by 0.4% on the Nasdaq 100. Danny, up by 0.4.
Yeah, I mean, finally, we're getting a little bit of a rebound, but I think it's notable that you had equity markets yesterday unable to continue gains. That finally you're in an environment where higher yields seemingly upset markets.
Those yields stick this morning on a 10-year, up by 2 basis points, 4.04. Danny, at the front end of the curve, we give it up, 3.99. On a 2-year.
It is, again, this kind of idea that maybe on the long end yesterday it was finally attractive again. Yay, 4%. I can go ahead and dive in. This time, maybe not. So, John, quickly, just to go through some of the movers this morning. Honeywell up nearly 2%. It's planning to spin off its advanced materials division, have a separately listed business by early 2026 at the latest. They want to simplify Honeywell's business around 3 main segments: aviation, automation, and the energy transition. Also higher this morning, NVIDIA. Before I get into the individual story, just worth noting that NVIDIA was one of the few Mag 7 to gain yesterday. And congrats, NVIDIA. You're now, again, the second largest company, overtaking Microsoft. The individual story this morning up more than 1.5%. Hon Hai is building a new server facility for them in Mexico because they say there is, quote, crazy demand for their Blackwell chips. Finally, just rounding that with Pepsi. John, you and I have already talked about this. PepsiCo cutting their outlook. Shares down 0.5%. The consumer, they say, is still value focused. There was an unexpected decline in summer sales. They're cutting costs, trying to keep up profits that way, but it is a cash-strapped consumer. They're dealing with boycotts in the Middle East and a major recall, all of that hitting volumes, John.
Are we going to see another quarter of those kind of headlines? A big emphasis on cost management. Danny, thanks. Let's talk about the week ahead. Turning our focus to this week's economic data. CPI coming on Thursday, followed by PPI on Friday. The inflation data offering clues for the Fed's rate path after the better-than-expected September payrolls report triggered fears of a no-landing scenario. or hopes, depending on how you look at things. Tom Porcelli of PGIM Fixed Income joins us now for more. Tom, good morning to you. It's good to see you.
Good to see you. How's everyone?
How high, how low is that bar to hit pause at the Federal Reserve?
I think that I think today it's relatively high. But in fairness, it's also lower than what it was before that payroll report. Look, I think the Fed is really going to start to try to understand where we are from a neutral perspective, even more so than what they've been doing over recent months. Because we were just saying before we came on, we said, what a week, and then we said, what a year. And then I said, actually, what's been really interesting about this year is that we've gone through like sort of almost a series of mini cycles.
What a year in a week.
Within a year. Yeah, exactly. And I think when I think about the data that we've been looking at, I mean, look, we've been in the soft landing camp for a while. Although I will hasten to add, I actually hate the term soft landing. I think I literally said on this show, the problem with soft landing is it sort of would suggest that things have stopped, right? If you landed, you've stopped. But if you want to keep it in aeronautical terms, I think we could talk about altitudes. And we thought that you would be operating in sort of an altitude of 1.5% to 2%. But I think if that report was to be believed, then you're in the upper end of that range. And I think that, to me, is really where the conversation is going. You
said if that report is to be believed. Just sort of tease that out a little bit more. What do you mean by that?
So I lobbed it out there like a big fat meatball for you. So I think what happened on Friday was pretty impressive. The report itself was pretty impressive. But it doesn't expunge all of the other data that we've been getting over the course. By the way, not even over the course of the last several months, just over the course of the last couple of weeks. I mean, we know that the quit rate is down. We know that the labor differential is down. I mean, there's a host of other labor data that I think you can't just erase. And again, look, we've been thinking that, again, things would sort of hang in there just fine. But I'm not ready to sort of say, hey, everything's okay now. The unemployment rate is still up 600 basis points. So I think, there's still a long way to go. I mean, the chapter is not over, right? I mean, I think it's still ongoing. And I think that's an important idea.
The irony, though, is it's a world awash in data, and you'd think that'd make the picture clearer. And for some reason, it's making it more
complicated.
Makes it
even muddier. Yeah, totally agree. Look, I think, and this is the challenge. I mean, we can have a whole hour-long session on this. I think post-COVID, I think that the seasonal adjustment process for some of these data points are probably a little quirky right now, and I think that's just something we have to sort of live with. I think about leisure and hospitality is sort of a great example. Leisure and hospitality jobs. You would normally see a massive decline in September in NSA terms. And we saw a big decline. It just wasn't as big as normal. So if you don't get as big of a decline as normal, then all of a sudden, in seasonally adjusted terms, it flatters the outcome. And again, that's not making excuses for the data. That's just being informed. I mean, I think we have to understand that there's a lot of quirkiness that seems to be going on, and I think sort of this back and forth on the data is really highlights that.
Well, on the data, we'll get one more jobs report before the Fed meets.
Yep.
And they've avoided one headache when it comes to the union workers.
Yep.
But how on earth are they going to look at the impact of the hurricane, Helene, and now the one that's about to hit Florida?
I hate to say this because we were just talking about this. This would be a sort of a great opportunity to use the word transitory. But that's been sort of, struck in from the lexicon at the Fed. But I think you have to look through some of this. I mean, some of these impacts are going to be temporary, which maybe is a better word than transitory. And I think that's going to be the reality. So I think this coming payroll report could be a little bit messy on the back of that. And I think we're going to have to look through that based on some temporary factors.
Let's talk about CPI. On Thursday. I'll share some of the language that John Williams shared with the Financial Times in the last 24 hours, that if inflation fell faster than expected, that would call for policy to normalise a little bit more quickly. If inflation stalled, that would call for interest rates to come down more slowly. I've asked this question a few times this morning. There's a bias to reduce interest rates regardless of what the inflation data looks like on Thursday. What do you take away from that?
Yeah, I think that's fair. I mean, I think that, policy was it's funny. I think one thing that Powell said, which I totally agree with, something we've been saying, is cutting rates now is all about extending the cycle, right? That's all they're trying to do right now. And we have nothing but sympathy for that idea. It's exactly what we think they're supposed to be doing. So I think in the context of policy that was calibrated for meaningfully higher inflation, with inflation now having come down, I think that you can easily take back some of that aggressive tightening that they put in place. So for us, we still think that, what this has done is it's removed the urgency to go aggressively. I still think you're going to get into the realm of neutral, but you could probably do that in a little more of a casual way.
And then this gets back to your point, though, of cycles happening seemingly in days. Before that Friday report, we were pricing in 20% odds that they cut by 50.
Yes.
Post-report, 20% odds that they just don't cut at all. What's needed, or when can I even expect a world where you don't have these wild swings in Fed pricing? You don't have bond markets swinging like they're mega cap stocks.
And Danny, think about it too. At the beginning of the year, the market was looking for 6 or 7 or even 8 cuts, and then they scaled that back, and now they were looking for aggressive. I mean, it's been a wild swing, which was to the conversation we were having a moment ago. Look, I get it. We're all at the mercy of this data that have been noisy. And again, it's just consider this. What if next month, payroll report, even excluding any of the hurricane impact and the strike impact, et cetera, you print 50,000. Which, by the way, is not out of the realm of possibility when you consider the sort of the standard error on this thing.
Sure.
So I just think we're at the mercy of what's been very volatile data.
You said the RAM are neutral. Can we explore that a little bit? What's the RAM and neutral?
Yeah, I also said Strucken, by the way. I'm just realizing when I should have said Stricken. So hopefully you can edit that out or something.
We'll try and edit that later.
I think the realm of neutral is somewhere between 3 and 3.5%. I think that's the right way of thinking about roughly where it is. I think we all appreciate it. It's very hard to know that number in real time, if ever. But I think that's probably where this is a journey to.
So do you think it's fair to say the next 100 basis points of decisions are the easy ones? Is it fair to say?
I think that is very fair to say. And look, I think if all of a sudden, and again, we have to be practical about this, if all of a sudden you're going to start printing 254,000 jobs month after month, then guess what? The easing cycle is coming to an end. Right? I mean, I think that some element of practical has to enter the equation on that.
My worry is that in a few months' time, we revise these numbers in a big way and people start to throw some accusations that they were put a certain way for political reasons, which we all know is not how it works down in Washington, D.C. But that would be my worry come December, looking back a few months.
Well, when those revisions came out for the year, it was down some 800,000, and now basically everyone comes on and says, doesn't matter what the payroll report number is, you take out 60 or 70. And in this report, a lot of people are sending me private messages why I'm not talking about the fact that I think government jobs was about 37,000. They're saying this is basically just to cook the books before the election.
Tom, just a final word on that. Where is the demand coming from? How much breadth is there in the demand for jobs in America?
I love this question, and I think it really gets to some of the nuance of the last report. I mean, you think about leisure and hospitality jobs, adding 80,000. The prior few months, it had been averaging, 40,000. So the delta was a massive swing. You think about healthcare, which has just been an engine. But over the prior few months, it was averaging maybe 30 or 40,000 jobs, and all of a sudden it bounced up to also about 70 or 80,000 jobs. So you had these big deltas. I think the biggest source of strength has been healthcare, full stop. I think it'll continue to be sort of a source of strength. But when I think about it sort of outside of that one really key point of strength, it's, you've seen modest gains sort of throughout or over the course of the last few months. But I think key is going to be healthcare. I mean, to me, that's a long-term structural idea based on aging populations and et cetera. And I think that will be an engine for a while.
A big tailwind for hiring. It's good to see you, Tom. Appreciate it, as always. Thank you, sir. Tom Porcelli there of PGIM Fixed Income on the Federal Reserve and the economic data in America. As we count you down to the opening bell, about 50 minutes away. Equity futures shaping up as follows on the S&P 500. A little bit of a bounce. We're up 0.4%. Yesterday's session, the biggest one-day loss in around about a month on the S&P 500. The Nasdaq 100 up by about 0.4%. The Russell up by a tenth. The bond market getting tons of attention over the last few days, particularly at the front end of the curve. The two-year high by almost 40 basis points through last week. Yesterday, we added to that some of that move. This morning, we take back just a little bit. We're down a basis point on a two-year at 398.33. On a 10-year, we hold on to 4%. We're up about a basis point or two, 4.04. With us around the table, logged into the Bloomberg terminal, Mark Cabana of Bank of America. Mark, it's good to see you.
Likewise, good to see you.
Thanks for joining us. What's changed from you and your calls for the Federal Reserve based on what happened on Friday?
Sure. We were in the 50 basis point cut camp for November. The data dictates that is no longer necessary. So we now think that they'll go 25 and that they'll deliver a string of 25 basis point rate cuts until they get to March of next year, so around 4%. And then they'll slow down to a quarterly pace of cuts until they get to a trough of 3 to 3.25. At least that's the base case. Now, I'll tell you that amongst our clients, there's a lot of uncertainty out there right now. The data has surprised. It doesn't seem like the data is giving us a particularly clear narrative on what's going to happen. And we sense that investors are really shifting probabilities of what the most likely economic outcome is. There was a lot of belief that we were headed to a soft landing with elevated risks of a recession, or at least increasing risks of a recession. Now, soft landing is still the base case, it seems, but the market is putting a little bit more weight on the possibility that maybe there's a quote-unquote no landing type scenario, or maybe the Fed doesn't need to cut much below 4% at all. And so the market right now, we think, given that uncertainty, is just trying to be a bit defensive. Rates clients don't want to extend too far out the curve right now, especially given that we're just about a month away from the election. And as a result of that, they're keeping things nimble and light and kind of waiting for data to try and guide a bit more.
We saw money pile into money market funds as well ahead of that economic data. And I've asked this a few times. What do you think is behind that move? What's driving that?
Rates are still high. And just because the Fed is cutting doesn't necessarily change your behavior as a depositor. Ask yourself, what does your retail bank deposit pay you? If it pays you something close to T-bill yield, you should tell me where you bank, because I'd be interested in knowing that. But for most retail depositors, they're offered something close to zero. And so T-bill rates are still well above that. And so we do think that there's going to continue to be a lot of inflows into money market mutual funds, even if the Fed is cutting. Because it's not about whether rates are rising or falling, it's about the overall level of interest rates. And work that we have done says that you shouldn't expect to see really large outflows from money funds unless the Fed cuts to something that is at or below 2%. And that seems very unlikely based upon the data that we have at hand and what the market is thinking about the Fed cutting cycle.
Mark, it's also a 10-year that's been going higher. Yields have been going higher, even since before the Fed cut by 50 basis points, and it's just continued on. How much of that is just a factor of what you first started talking about, that unknowingness, that vulnerability, and that volatility just adding a premium to this bond market?
Well, I think it's a couple of things. Number one, I think it's that rates investors do believe that a more proactive Fed today means a better economy tomorrow. And think about on the day when we saw the Fed cut 50. You actually saw long end yields rise because there was a sense that the Fed was going to be decisive, act quickly, do what it takes to support the economy, and then that should allow for better growth in the future. That, we think, is arguably the biggest part of why the back end has been moving up a bit. But there's also supply-demand concerns, and the election is a big wild card. Certainly, it doesn't seem like fiscal policy is going to be tightened in a big way after the election. And so we can debate, well, how easy will fiscal policy get based upon the election outcome? But I think investors are just a little bit reluctant to extend out the curve, knowing that you can get political outcomes that would result in much easier fiscal policy and more Treasury supply.
As you're saying this, though, I'm thinking in my head, who is the candidate for less fiscal spending?
So I don't want to get into the politics too much, but
it's a good response.
Thanks. Yeah, I've been trained well by B of A media people. Investors right now do not expect that there's really any party or any candidate that supports meaningful fiscal austerity. And so therefore, it's just a question of whether or not the fiscal outlook gets a lot worse or a little worse. And investors, knowing that the election is very tight and knowing that investors don't want to take a strong call on that right now, are deciding to just stay a little bit shorter duration. So some of the flows work that members of my team do sees that there are very sizable inflows into fixed income funds, not too different from the money market mutual fund inflows, John, that you referred to earlier. But when those flows come in, they're generally staying short on the curve. And that is due to investors who just don't have a lot of confidence in what the political or macro backdrop looks like in a month or so. And as a result of that, these positions are kind of de facto in steepeners. And when you get really strong data, like we had on Friday, then that does create a bit of a tension for investors who have moved further in on the curve.
Jonathan and I were just talking about the fact that if we might not have a decision days or even weeks out, this could also drag on for months. This could be contested. What do flows on the short end look like then?
So it's a great question. I guess I would just respond by saying that over recent weeks and months, we have certainly seen that Treasuries have regained their flight to quality attributes. When inflation was high, let's say rewind a year ago or so, I think we could have debated how much Treasuries actually retained that flight to quality benefit. But if there is acute uncertainty, whether it's due to U.S. politics or whether it's due to geopolitics, we do think that Treasuries will still retain that flight to quality attribute. And we should expect to see cash move into Treasury securities, probably mostly at the front or belly of the curve in those types of scenarios. But certainly for the asset class overall, we do think that it will retain those kind of risk-off or flight to quality benefits that we have historically seen.
We've talked a lot about the front end. You've talked about how that money and money market funds could be quite sticky unless Fed funds comes down to something like 2. Can we talk about the long end and just finish there?
Sure.
What are you looking for at the long end of the curve? What kind of numbers? We had a guest from PGIM yesterday saying we're in the buy zone, 4% to 4.25, lock it in. Get a second buy, a second opportunity, take it. What's your advice?
Yeah, so we wrote yesterday that we do think, at least using the 10-year as a proxy, between 4 to 4.25 is a reasonable place to begin scaling in. We're already there, obviously. But here's the framework that we have used. And a number of folks on our team have recently written about this in slightly different ways. But we call it a 2-3-4 type framework. The Fed is almost certainly going to cut to 4%, almost regardless of the data. Don't believe me, look at their dots. In 2025, all dots except one are below 4%. So that seems to be the recalibration zone, and that's maybe consistent with quote-unquote no landing. And so if the economy performs really well, then 4% is probably where they'll end up. In a soft landing scenario, using the Fed's own baseline, they'll probably end up closer to 3%. That's the B of A house view. That's our economists' view as well. And if there's a recession or some type of sharp slowdown, then you can envision a 2% or lower type of outcome. So then the question is really, how do you assign probabilities to those various outcomes? And again, our base case is the soft landing. That's all well and good. But if you just look at 10-year OIS, let's say, that's around 360 at the moment. If that gets up to 375 or even higher, then clearly the market is overweighting that 4% outcome, that so-called no landing outcome. And investors can decide for themselves whether or not they think that's reasonable. We think that's very optimistic. And the world's a very uncertain place. The rest of the world is maybe not as robust as the U.S. is. And so to think that we could slip into a soft landing or a potentially harder landing is not unreasonable. And again, U.S. rates and fixed income provide a hedge against those outcomes. And therefore, we do think that if 10-year OIS gets to 375, again, be thinking the 10-year close to 415, 425 at that point, we do think that it's a very reasonable opportunity to begin to scale in and trust that it should perform at some point, or at least that your downside is very limited if you're investing around those levels.
Mark, appreciate it.
Yeah,
good
thanks
to see
for having
you.
me.
Thank you, sir. Mark Urbana there of Bank of America. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Billionaire Lululemon founder Chip Wilson's $60 million Vancouver home was vandalized over the weekend. The beachfront house was covered with graffiti messages attacking him. This coming just days after a sign was erected outside his house with a message calling British Columbia Premier David Eby's new Democratic Party communist. This coming amid a polarized election campaign with British Columbia residents voting October 19th to elect a new provincial government. And Samsung issued a rare apology to investors after disappointing results on revenue and profit. The Korean tech giant admitted it's struggling with delays in delivering a key type of chip used with NVIDIA processors for training AI models. It also warned about inventory adjustments as well as increasing competition. The head of the semiconductor division went as far as pledging it will review its organizational culture and processes. And in sports, the Yankees and Royals are tied at 1 game apiece after a 4-2 Kansas City win in the Bronx last night. The Detroit Tigers also getting the equalizer against Cleveland, with that series tied at 1-1 as well. And in football, the Kansas City Chiefs joined the Minnesota Vikings as the last remaining undefeated teams after taking down the Saints on Monday Night Football. That's your Bloomberg Brief. John?
Yahara, thank you. Up next, we'll set you up for the day ahead and we'll catch up with Bramo ahead of her exclusive conversation with the JP Morgan boss, Jamie Dimon. Counting you down to the opening bell, the calendar looks like this. Today we'll hear from the Fed speak from Bostic, Collins and Jefferson. Wednesday we'll get Fed minutes. Thursday CPI plus another round of jobless claims and Delta earnings. And on Friday PPI and new Mitch sentiment and big bank earnings kicking off with Wells Fargo and JP Morgan. Coming up in about 30 minutes, the JP Morgan boss, Jamie Dimon, sitting down with Lisa. Lisa joins us right now for a preview. Morning, Bramo.
Hey, good morning, John. I'm here in London, which occasionally is sunny and occasionally is pouring. I never know which. I have to say, you were just talking with Mohamed El-Erian earlier in the show, and he was saying that this is a market that lacks anchors. And there is no one better to speak to than the chief of the world's biggest bank to understand what are his anchors. How is his risk evaluation at a time that is highly uncertain, both from an economic perspective, from a tech perspective? This is a tech conference with a number of tech startups that are looking to potentially IPO. Are they still interested? And then, of course, the geopolitical backdrop with politics very much front and center. We're going to address all of that here as I sit at the bar at the Novo Hotel near Marble Arch.
No drinking. Lisa, thank you. Looking forward to it. 9:30 Eastern Time, must-watch TV. Lisa's interview on Bloomberg at 9:30 Eastern Time with the JP Morgan boss, Jamie Dimon. Coming up tomorrow on this programme, we'll catch up with Andrew Sheets of Morgan Stanley, Hugh Van Steenis of Oliver Wyman, Cameron Dawson of New Edge, and Amanda Liner of BlackRock. All of that and a whole lot more. And, of course, some highlights from Lisa's conversation a little bit later this morning. Equity futures on the S&P 500 bouncing back just about positive by 1/3% on the S&P 500. And the 10-year, we add some weight to that yield. Up another basis point, 4.04%. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.